Ladies and gentlemen, a kind request to everyone to settle down. Also, please keep your phones on silent mode. We are about to begin. Well, I think we're good to go ahead. Good morning, everybody. Good morning. Namaste. A very, very warm welcome to all of you to the inaugural Pan India Outreach Program for Corporate Bonds. My name is Mayuri Malankar, and I'm delighted to be a host for this event. Thank you so much, everyone, for taking out time from your busy schedule and being a part of this event. Before we proceed, I'll request everybody to kindly rise for the national anthem.
जनगण मन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड उत्कल बंगा विंध्य हिमाचल यमुना गंगा उच्चल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मांगे गाहे तव जय गाथा जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे
Jai Hind. And now, ladies and gentlemen, we will begin with the inaugural proceedings with the traditional lighting of the lamp. I would like to invite our dignitaries on the stage for the same. Beginning with Shri Tuhin Kanta Pandey, a very, very warm welcome to you, sir. Please put your hands together for Shri Amarjeet Singh. A big round of applause for Shri Ashish Kumar Chauhan. I would also like to invite on the stage Shri Sundar Raman Ramamurthy. Requesting Ms. Maninda Chima to join us on the stage for the same. May I request Mr. Dinesh Pant to kindly join us on the stage for the lamp lighting. Can we take one group photo, please? हमारी भारतीय परंपरा के अनुसार दीप प्रज्वलन कर इस कार्यक्रम की शुरुआत हो चुकी है. Thank you, everybody. You may now take your seat. Moving ahead, ladies and gentlemen, to set the context of today's program, we now invite Shri K. Sarvanan, Chief General Manager, SEBI, to deliver the preamble of this event. Can we please welcome him with a round of applause?
Very good morning and greetings to everybody. It's my pleasure to be present over here today in such an important program. My role over here is to share with you all our experience of how we got the idea of getting into this Pan-India Corporate Bond Program. Chairman sir, he had a meeting with the TDHs once. During the times there was mentioned to us about corporate bonds, its depth, about liquidity and so many aspects, later aspects, and also sir was talking about awareness programs to be conducted, especially for bonds. Then subsequently I had a meeting with Mr. Amarjit Singh also, our whole team member. He was also mentioning to me, Saravanan, we have to do something on corporate bond. This time it is from the issuers perspective. We need to reach out to issuers. We need to understand why they are not coming, and somebody who had come for the first time, why he is not coming for the second time. So he said you have to do that. So the directions have come from two persons, especially from from the highest authority also. Then immediately what we did was at DDHS, we contacted the exchanges, both at BSC and NSC. We were discussing like how to go about with respect to this particular program on corporate bonds specifically. And we were all discussing one thing, that we need to have some kind of tagline for this particular bond as an instrument, because we know the success of our mutual funds with respect to mutual funds Sahi Hai campaign. So on similar lines, we wanted to have something for this also, and OBPs were approached. They also, okay, no, I readily accepted, and we wanted to have a tagline whereby bond is a bandhan. It's a relationship which is salubrious relationship between the issuer and the investor. This needs to be captured in the form of a tagline. So tagline was made ready. Then we also wanted to bring out some kind of documentary on bond, because bond is not something new for any of us. This has been there for time immemorial. So how do we bring it to the attention of the audience, be it issuers or investors, whoever it is? So we have one documentary on bond, which is talking about the asset planning stage to till today, how this particular instrument has been living with us. Then chairman also said that last time that we had to do some programs for investors. We need to bring some awareness videos. Chairman said we are ready with not just one. In fact, the exchange is ready with 4 such videos today. So 4 such videos are talking about investors, what investors should take care of, what are precautions that they should take care of. 4 such videos have been brought out today, and this is how we are going to go about, and all these launches are going to be done shortly at your hands. And sir, as far as this thing here is concerned, of now, documentary is concerned, we are bringing that point over here, and also investor camps we have been doing, and now we have to reach out to the issues also. We are going to discuss with them about the ground realities and bring it over here. So this is the kind of important activity that we are planning to do, and this we want to do only with the blessings of you all. This is a family actually where we are part of. It's customary for us to take the blessings of the elders in the family. So we are here seeking your blessings, all of you, and we have to march ahead. After seeking your blessings and good wishes, sir. Thanks for the opportunity given to me.
Ladies and gentlemen, I would like to invite the NSC and a BSc team on the stage along with the Saravanan sir. They have been working closely on this for the photo op. May I have the entire team on the stage? Meanwhile, I would like to thank Sri K. Saravanan for those insightful thoughts on the sentiments and truly setting the tone for the day. So your words have brought us the right energy in this atmosphere and the positive vibes as we move ahead. Thank you once again. I would once again like to invite Sri K. Saravanan back on the stage before I invite the next speaker. May I request Sri K. Saravanan to please join us back on the stage. Ladies and gentlemen, our next speaker, Sri Amarjit Singh, is a whole-time member of SEBI, and he'll be presenting the opening address. I will request him to join us on the stage. But before he starts his speech, we would like to present a lovely bouquet of flowers. May I request Sri Saravanan sir to please present a bouquet to Mr. Amarjit Singh, whole-time member of SEBI. Thank you, Mr. Saravanan.
Good morning, everyone. Respected Chairman, Shri Ashish Kumar Chauhan, NSC MD, Sundar, BSc MD, other dignitaries in the audience, colleagues from SEBI, ladies and gentlemen, friends, it's indeed a pleasure for me to welcome all of you to this event. I'll begin by thanking Sarvanan and Maninder and other SEBI colleagues, and also the colleagues from BSc and NSC for putting this event together. As Sarvanan mentioned, development of corporate bond market has been a high priority for us for many years, and lately our thinking has been, can we do something different? Can we do something which we've not tried so far? As you all know, a lot of policy tweaks have been done over a number of years, but we still have a long way to go. And I'll come to that part in my formal address. So, just to add to the context which Sarvanan tried to outline, here our thinking is, can we go beyond, our policy chairs, come to the ground, come to the field, talk to the issuers, talk to the investors, talk to other stakeholders, and get a real pulse as to what is the problem, what is the root cause, why we are not seeing the kind of traction we want to see, despite, everybody has been very sincerely, not just SEBI, I must say this also, exchanges, Government of India, RBI, everyone has been very sincerely trying to make this market work. But somehow, as I said, we are not where we would like to see ourselves in this space. Let me turn to my formal remarks. While equity continues to dominate the wider public discourse, every day in almost every household, Sensex and Nifty is getting discussed today. Development of corporate bond market has been an area of high priority for a long time. A number of high-level committees, right from the days of Dr. R.H. Patil, and we had Percy Mistry committee also, then Achar Khan committee. They've delved deeper into the various issues, and subject has also figured in several budget speeches, including the latest one delivered by Honorable FM on February 1, just 3 days back. If I can talk a little bit about the announcements made in Budget 2026, they relate to market making framework, having derivatives on corporate bond indices, and we are very actively working on this, and the introduction of total return swaps on corporate bonds. All these announcements very clearly reflect the continuing focus on further development of the corporate bond market. Over the past decade, India's corporate bond market has expanded significantly. Outstanding issuances have increased from rupees 19 trillion approximately to rupees 58 trillion at the end of December 2025, which is roughly a CAGR of almost 12%. And if you look at the primary market issuance, we have a very healthy number of close to 1 lakh crore almost every month being raised through corporate bonds. The progress is encouraging, but it is equally clear, as I mentioned, that we still have a long way to go. At around 16% of GDP, the size of India's corporate bond market remains modest compared to developed economies, representing untapped potential. Just to give you some comparative perspective, some numbers from the other markets which are comparable. South Korea 79% almost of GDP, China around 38%, Malaysia around 54%. Today's outreach program is a part of SEBI's broader policy objective of developing the corporate bond market. Our intent is to engage not only with issuers, although as Sarvanan also mentioned, focuses issuers, but also with other stakeholders, and encourage greater participation in market-based debt financing. And I thank stock exchanges and other stakeholders who have come together to make this event happen. I'll just focus on two aspects, some key challenges, and also briefly outline some of the main initiatives that have been taken by SEBI in the space over several years. So just to talk a little bit about the key challenges. Currently, Indian corporates are heavily reliant on bank credit, which constitutes over 56% of GDP. However, the demands of the coming decades, particularly in infrastructure, energy transition, and capital-intensive sectors, these cannot be met by bank credit alone. Therefore, that's where corporate bond market comes in. There's a need for a deeper and more vibrant corporate bond market to complement banks and diversify funding sources. At the same time, we also need to acknowledge that the corporate bond market continues, and I want to underline continues because we've been facing these issues for many years, to face a few structural challenges that need to be addressed for it to play this role at scale. The first challenge, and many of you know this, there's no news here, is of concentration. Nearly 85 to 90% of issuances are concentrated in top-rated securities, restricting access for smaller players. Second issue is liquidity in the secondary markets. Lately, we are seeing some traction. Trading volumes seem to be getting better. And just to give you some sense of that, average trading volumes in the first 6 months of financial year 26 increased to around 9,000 crore from INR 6580 crore in the previous year. There is, however, considerable scope for improvement. The third issue is participation. Retail participation remains limited, with the bulk of issuances occurring through private placements that are primarily accessible to institutional investors. And also, just to add to this, even the issuance space is dominated by NBFCs. So that also is another area. Let me very quickly mention about some of the measures taken by us before I conclude. We've taken a series of reforms aimed at improving transparency, access, and liquidity. Very clearly, these reforms aim to address the issues in both primary and secondary market. In the market infrastructure space, we've taken initiatives such as EBP, Electronic Book Building Mechanism, RFQ platform, and Limited Purpose Clearing Corporation for corporate bond repos. Measures such as reducing the face value of corporate bonds, introducing online bond platform providers are aimed at making the bond market more accessible. To talk about more recent measures that we took in I believe in our last board meeting, in order to further facilitate ease of doing business, we've recently raised the threshold for identifying HVDLEs as high value debt listed companies, which are exclusively debt listed. So there was a threshold of 1,000 crore for their identification. We've increased it to 5,000 crore. What does it mean? I mean, how does it help? So based on the current universe, as of June 30, 2025, this increase in threshold would reduce the number of entities covered under the applicability of corporate governance framework from 137 to 48. So 137 minus 48 companies don't have to comply with the stricter corporate governance requirements, and for good reasons we've done that. Let me conclude. For corporates, the case for accessing the bond markets is compelling. Issuance of bonds allows for diversification of funding sources and enhances resilience during credit tightening cycles. Bond markets can offer competitive pricing and flexibility in structuring in terms of coupons, tenors, and repayment profiles. We've lined up a couple of panel discussions today. These panel discussions are on fundraising through debt securities and on addressing liquidity concerns in bonds. These are very timely discussions and highly relevant. I encourage all of you in the room to participate and engage actively. Let me conclude by reiterating that SEBI remains committed to simplifying regulatory processes where feasible, encouraging innovation, strengthening investor protection, and working closely with stakeholders to remove structural bottlenecks. We view issuers not merely as regulated entities, but as partners in market development. I look forward to the deliberations today, and once again, I would like to thank the teams in SEBI and NSE and BSE and others who have contributed in making this program happen today. Thank you very much.
Thank you very much, sir, for sharing such valuable insights with us. The data and the key numbers that you highlighted have given us the clear understanding of the market progress and the opportunities ahead. Thank you once again. Moving ahead, ladies and gentlemen, I would like to invite on the stage Shri Ashish Kumar Chauhan, Managing Director and the CEO of National Stock Exchange of India Limited. Please welcome him with a thunderous round of applause. We would like to welcome Shri Ashish Kumar Chauhan with a lovely bouquet of flowers. May I request Shri Debashish Bandopadhyay, CGM of SEBI, to kindly join us on the same.
Respected Chairman SEBI, Shri Tuhin Kanta Pandey, whole-time member SEBI, Shri Amarjit Singh, ED SEBI, Sushri Maninder Chima, Shri Sundaraman Ramamurthy, MD and CEO BSE, senior officials from SEBI, representatives from listed companies, merchant bankers, investors, and other market participants, colleagues from NSE, BSE, other market infrastructure institutions, members of the media, ladies and gentlemen. A very good morning to all of you. It's a privilege and honor to welcome you to the inaugural Pan-India Outreach Program for Corporate Bonds, a landmark initiative of SEBI. Today's program brings together issuers, intermediaries, investors, and policymakers, followed by focused discussions on debt fundraising and secondary market liquidity. For years, we have all been discussing the need to deepen the corporate bond markets. But now the time for action is more pronounced because India's growth ambitions and financing needs will not wait. In fact, NSE's journey started with the debt market segment in June 1994. That is the month when actual official inauguration happened. We started trading on a beta basis. That time beta as a concept was not even known to us, but we started slightly before that. And then Honorable Finance Minister at that time, Dr. Manmohan Singh, came to inaugurate in June 94. And then few months later, in equities, we started trading on November 3, 94. In over 3.5 decades since we started working on NSE, we have consistently heard the same refrain that India must build deeper debt markets, and this initiative matters today because deepening bonds is not a nice to have anymore. It's a national financing necessity. So I thank SEBI for driving a reform-led, market-led agenda that is steadily moving India's bond market from possible to practice. India is no longer merely emerging. We are defining our own trajectory towards the vision of Viksit Bharat by 2047 under the strong leadership of Honorable Prime Minister Shri Narendra Modi ji, recent progress on trade deals with European Union and the United States strengthens India's growth runway by improving market access and predictability for Indian industry. This is exactly the kind of tailwind that makes even more urgent to build a mature corporate bond market that can finance export capacity, supply chains, and long duration investment. Debt is not a new idea. It is one of the oldest ideas in human life. In fact, even Rig Veda, the Rin, it's not necessarily monetary Rin, but Rin is a very important facet of life or day-to-day life. We borrow a little small ball of sugar from our neighbor, and then we give it back with some gulab jamun. That is also returning of our Rin with interest in some ways. And that is why it's amazing how we have not been able to develop this market. But a promise to repay, backed by credibility, cash flows and trust, and even temples, the churches, the Buddha viharas across the world used to be the lenders to not only individuals but also to kingdoms. And that's where all the entire framework of finance actually evolved. The first double entry bookkeeping system treaties were written by an Italian priest called Luca Pacioli, and I used to wonder why an Italian priest had to write a double entry bookkeeping system framework is because they were the people with money, they were the lending people, and that's why they had to also take it back. But in some ways, the entire Europe, when it developed on bonds, all their physical infrastructure, the municipal bonds, the state bonds, and the government bonds, including war bonds, if we recall. So there are, over a time, there is an expansion from intermediation to measured disintermediation, where capital moves through transparent market platforms rather than only through balance sheets of intermediaries. Banks are good for working capital and shorter tenor credit. And here I might remind you that India is pretty much amongst the lowest leveraged countries, the large countries in the world. Today, our banking system size to GDP is very low compared to the rest of the world. And similarly, overall indebtedness in the economy is also very low compared to the GDP. And that's where it allows us a way to create this bond markets, even a loan market. Even our loans books with the banking systems are not that high compared to the size of GDP. And so it allows us to now expand the entire bond and loan portfolio so that we finance the corporates and they create more jobs, they create more exports. And that's where bonds are essential for long duration nation building, infrastructure, housing, energy transition, manufacturing, and many more. To meet our net zero targets by 2070 alone, India will require investments exceeding $10 trillion. A deeper bond market also strengthens pensions, insurance, reduces asset liability mismatches, and improves system-wide resilience. India's equity markets are globally respected, with market capitalization crossing $5 trillion in about 3 decades since NSE began operations. Now we need the same multiplier effect in debt. Since financial year 22, NSE has enabled fund mobilization of about 76 lakh crore rupees, out of which about 60 lakh crore has been raised through debt platforms. In 25 alone, NSE facilitated 20 lakh crore rupees, the highest ever, of which over 15 lakh crore was through debt instruments, which includes commercial paper. Notably, funds mobilized through NSE is much higher than the incremental credit offtake by banks to industry. So we are not small compared to the size of our banking system. We are pretty large now. And each year we are giving more money through bonds compared to the banking system lending to industry every year, year after year. But overall, the size of the pie is less compared to our economic size. And the composition shows what must change. In 25, about 9.2 lakh crore came through commercial paper and 5.9 lakh crore came through private placed NCDs, while public NCDs were only 2,257 crore. In 2025, public NCD issuances accounted for only 0.15% of total debt raised. Amarjit Singh also mentioned about it. The destination is clear. More listed public issuances repeat issuers, and active secondary trading. But that will also require us to ease the paperwork for coming out with the public issuances, because private issuances now can happen literally in a matter of days, while as the public issuances are taking longer time because of absolutely different reasons that we need to protect the small investors. And so we require price discovery to be continuous and not episodic. To the issuers and business leaders present here today, I would like to make a clear and direct invitation. Please consider the listed corporate bond markets as a long-term funding partner and engage with it consistently. India's growth needs more frequent, transparent, benchmark-style public issuances from high-quality companies across sectors. The opportunity to broaden the issuer base is significant. Debt cannot be cost-effective relative to equity for many issuers, especially when cash flows are predictable, because it avoids dilution and can reduce the weighted cost of capital. At NSE, we are committed to support you all through the life cycle, efficient primary issuance through our electronic bidding platform, stronger secondary market access through the RFQ ecosystem, and sustained issuer engagement to help you prepare for disclosures, documentation, and investor communications. We'll work closely with you and with intermediaries as well as SEBI to ensure that the process is orderly and smooth. Our assurance is simple. If you are prepared to meet the standards of transparency and governance that build trust, NSE will be a steady partner in helping you diversify funding sources, broaden your investor base, extend maturities, and raise long-duration capital at scale. NSE's electronic bidding platform and request for quote platforms have emerged as pivotal enablers of transparent, efficient, and competitive price discovery in primary and secondary markets, respectively. Our EBP facilitated bond issuance worth 4.85 lakh crore in financial year 25, making a robust 32% year-on-year growth. Our RFQ platform achieved a record high daily volume of 5,676 crore in financial year 26 so far. The ecosystem has further deepened with online bond platform providers, OBPP, some of you who are sitting here, expanding access through digital distribution. Today, 29 registered OBPPs have collectively facilitated over 20 lakh gross trades in financial year 26 till date. It is therefore apt that SEBI is launching the OBPP tagline, documentary and awareness videos today, because access, awareness, and trust are essential to depth. Liquidity is also broadening. The number of trades per issuer has increased from 116 in financial year 22 for the entire year to now more than 1,083 per issuer in financial year 26. Already some more time has, there are still 2 more months to go. Covering OTC, that is CBRICS, and the RFQ platform at NSE, an important sign of improving participation and distribution of activity. It is also good to see the process in green bonds. Financial year 26 has already seen a record 2,070 crore raised compared to 825 crore in financial year 25. We are building market capability through issuer-focused capacity building with partners such as IFC and the Climate Bonds Initiative, and strengthening awareness of credit enhancement and de-risking structures. We have received many of this bond listed with even foreign participants giving credit enhancement recently, so that green finance can move from niche to mainstream, especially for long-term infrastructure funding. Despite advances, India's corporate bond market stands at about 15 to 16% of GDP, as Sri Amarjit Singh said, well below global benchmarks. In advanced economies, deep corporate bond markets with active secondary trading and large sustainable debt programs are a primary engine of long-term finance. India now needs the same maturity at scale. Niti Aayog projects these markets can grow to 120 lakh crore by 2030. To get there, liquidity must follow standardization, fewer, larger, repeat issuances, clear benchmark tenors, and consistent disclosures. And we must responsibly expand access beyond only AAA issuers using tools like partial guarantees and blended finance. The Union Budget 26-27 has proposed an infrastructure risk guarantee fund to provide calibrated partial credit guarantees, exactly the kind of risk mitigation architecture that can crowd in long-term bond investors, especially for infrastructure-linked insurers. The budget also proposed market making and derivatives on corporate bond indices, along with total return swaps on corporate bonds. These announcements directly address the missing middle of our bond market, that continuous liquidity, tradable benchmarks, and modern risk transfer tools are essential for growth of the market. And as we widen issuance beyond the largest corporates, the budget's corporate Mitras proposal can help more MSMEs and mid-sized issuers navigate compliances and disclosure requirements at affordable cost. The proposal to introduce trades receivable as asset-based securities can further broaden the ecosystem by creating diversified tradable pools of risk. There is also an important push to municipal bonds, an incentive of 100 crore for a single issuance of above 1,000 crores, while continuing Amrit support for issuances up to 200 crore. In fact, immediately yesterday, there was an announcement, at least whether it actually happened or not, but there was a newspaper article that BMC, which is the most cash-rich municipality in India, is now, which was heartening news, that immediately after the budget was announced, even the large municipalities are trying to now prepare themselves. Some of you sitting here might like to pitch your services to them. None of this progress would be possible without SEBI's leadership. My sincere appreciation for Chairman SEBI, Shri Tuhin Kanta Pandeji, and whole-time member SEBI, Shri Amarjit Singh Ji, for their sustained focus on developing India's corporate bond market through reforms that improve transparency, standardization, investor protection, and secondary market liquidity. The success of SEBI's municipal bond outreach, which led to record 12 issuances this financial year, stands as a powerful precedent. We can do much more. The first chapter of India's capital market story was about scale. The next chapter must be about depth. Depth in debt, governance, disclosures, and above all, investor trust. If we want a truly liquid bond market, we must support three pillars: wider public issuances, active secondary trading, and continuous market making, backed by strong credit research, investor awareness, and confidence in disclosures and market integrity. Getting insurance companies to invest in long-term bonds is an absolute necessity. And somewhere, I think we will have to do much more coordination amongst the regulators to enable this. In the end, a bond is not just a security, it's a promise. Equity finances aspirations, but debt finances commitment. Equity can forgive volatility, but debt does not forgive complacency. Once again, to the issuers here today, NSE will work closely with you at every step so that issuance is efficient, disclosures are robust, and your access to long-term capital becomes smoother and more scalable. When India's savings flow through transparent, trusted bond markets into productive enterprise, capital does more than earn returns. It builds the nation. Thank you. Jai Hind.
Thank you very much, sir, for sharing your valuable insights on the market development, investor confidence, and the importance of deepening the corporate bond market. Also, thank you for sharing your thoughts and the NSE's role in strengthening the ecosystem. This has truly added great value to today's conference. Thank you so much. And with this, we move ahead, ladies and gentlemen. I would like to invite on the stage Sri Sundaraman Ramamurthy, Managing Director and CEO of BSC Limited. Can we please welcome him with a big round of applause? To welcome Sri Sundaraman Ramamurthy with a lovely bouquet of flowers, may I once again call upon stage Sri Debashish Bandopadhyay, CGM of SEBI. Very, very warm welcome to you, sir. Thank you, Debashish, sir.
Respected Chairman SEBI, whole-time member SEBI and Executive Director SEBI, the CGM and other colleagues from SEBI, and Shri Ashish Kumar Chauhan ji from NSE, various market participants who have assembled here, and my colleagues from NSE and BSE. Hardik Pranam. I feel very happy to be standing here and talking about corporate bonds today. Indeed, it is a great initiative, but I am having a dilemma now. What is there for me to speak? The WTM and my senior Ashish has already spoken a lot on this market. So let me pick on whatever they talked here and there and make some statements. Ashish ji talked about mention of Ren in Rigveda. What may be lesser known to us is there was a very good concept of interest and interest waiver during Vedic period. Yajurveda uses a term called kusidam. The term kusidam refers to interest, and it talks about unpaid interest and the sin arising out of not paying the interest, and tries to tell people how they can get out of that sin. It is enshrined in a mantra called Kushmanda. It's part of Krishna Yajurveda. So it was a very well developed society which talked about interest, payment of interest, non-payment, and the sin arising out of it. Under the able guidance of our Honorable Prime Minister, way towards Viksit Bharat. All tariff issues are becoming tariff advantages with lot of agreements being signed and progress being made. We are talking about a 30 trillion economy. If you are talking of a 30 trillion economy, it can't happen without capital. And all capital cannot be equity. Already it looks like we as a society, we are more oriented towards equity at this point of time, while the past appears to have been very different. Should there not be a balance? Yes, it has to be. It reduces the burden on banking. It eases the progress and growth of industries. Also, is it not a viable alternative investment instrument for many of us? It's going to give us sort of fixed returns which we can plan for, particularly people like me who are about to retire. It's a very important source of predictable return, which is very important, which is an aspect at this point of time I think needs more emphasis to the retail segment. We are talking about a 120 trillion funding gap, it was mentioned. Even if 18% of that funding gap or 15% of that funding gap were to come from retail as corporate bond subscriptions, we are talking of a big number. Our WTM sir talked about how in other markets corporate bonds are very big compared to what we have here. Yes, indeed we have grown a lot. Lot of numbers were told about how the number of transactions have grown, how the issuances have grown from a 17.5 trillion to today we are talking of 54 trillion, a CAGR of 12%. It was also told how compared to US, compared to Korea, compared to Malaysia, we are having much lesser portion of our GDP coming from corporate bonds, clearly underlying that there is a great possibility for us to increase our efforts on corporate bond. One is of course public issuances, second is market making, third is awareness, which Ashish ji mentioned. I think the awareness portion of it for the first time in the history in this way, thanks to SEBI, is happening. If this were to catch momentum, which I am sure it will, like what we are today talking about mutual funds, particularly large cap mutual funds, as a slightly safer instrument for investment, you should be able to talk about corporate bonds. Lot of efforts from everybody's side. People are talking about today, budget announcement talks about market making, total return swaps. I'm just going to talk two parts before I call it a day. One is there is an ecosystem development required for any product to sustain its roots. For corporate bond, there are some generic ecosystems and there are specific ecosystems to us. The generic ecosystem is there should be all type of participants in the market with all types of capabilities to participate. When we talk of corporate bonds, it is an interest rate instrument. So we need to have, therefore, a very good sovereign bond curve across multiple maturities to benchmark and measure the risk arising out of a corporate bond. That is an area which is very important as an ecosystem. And when we talk of issuances, huge percentage, 80 plus, 90 plus percentage only in AA and AAA, whereas in US and all it is just 5%. There are no other instruments. Two reasons. Today institutions are all clustered and required to contribute only to these instruments. So there are no issuances. And second, if somebody were to take a risk with a BBB bond, are there ways to hedge themselves? So that is the second part of the environment. An interest rate derivative, a securitization market, probably a credit derivative actively present, not for all, but for big participants at least to play, will take care of the environment in a big way. That is generic. It can be talked about anywhere in the world. Specific is, in India, any product can succeed only with retail support. Why? The entire market microstructure is defined towards the retailer. So therefore, how do we bring him in that area? I think these type of efforts of awareness creation, all of us jointly going and talking to the retail investors about the importance of corporate bond in his portfolio. People always look into what is in it for me. We need to tell what is in it for the retail investor. That will help. This is from an environment perspective. I have certain thoughts on specific actions. Are they very well thought about, well analyzed? No. I'm just voicing them out as they come to my mind. Some amount of pressure works. Too much of pressure is a pain. What is the pressure I am talking about? If any corporate is depending on bank finance beyond a limit, up to this is understood, they should be required to do some minimum public issuance of corporate debt. Not minimum issuance of corporate debt, minimum public issuances of corporate debt. If any corporate is having corporate debt outstanding beyond the threshold, they should be required to have again a specified percentage of corporate debt. This is nothing new. In equities, we talk about clearly free float, minimum public shareholding. So we should probably think on those lines. Maybe today we are restricting up to AA exposure to institution. Is it time for us to think about lowering down that credit limit so that bigger issuances can happen? And already in a way, as Chairman Sir was mentioning before we all walked in, there is a limit up to which, threshold up to which there is no income tax for anybody. Some amount of corporate tax, corporate bond income there would be helpful. Should we think of to encourage, at least for a period of 3 years, some tax exemption, some minimum limit? Maybe we should think about. WTM talked about the corporate disclosures and how the burden has been reduced. I'm talking about increasing the burden. What do I mean? In case some corporate is ready to issue a triple B or a double B, maybe with a better disclosure norm, they should be permitted so that the investing public knows what they are doing and can be comfortable about it. Can we permit higher number of investors under private placement and not count the retailers within the 200 number? Can we introduce a non-competitive bidding process within the EBP setup? Say all issues with the size above 1000 crores should mandatorily access 10% of the issue size to retail investors. Can we say such something? There are quite a few thought process in this. Maybe at some point of time, all of us can sit together, somewhere discuss whether out of this 10, 20 which I have as thought in my mind, even if 5 were to materialize or 3 were to materialize, I'm sure we will be making greater progress. Point is very clear. It is no longer an option. It is a necessity that we grow this market. Not only from an economics perspective and economy perspective, from an individual perspective as well, to have a well-diversified portfolio. SEBI has made great strides in this country's capital market development, particularly in the area of equities through the investor protection programs and investor awareness creation programs. Now that we have made a beginning for replicating the same in corporate bond market, I am sure next year when we talk here, we would have crossed the 1 crore transactions which we talked about and many other limits. Thank you very much for hearing me patiently and for this opportunity given by SEBI to me. Namaskar.
Thank you, sir, for your insightful address. Your perspective on building a stronger market ecosystem, enhancing investor participation, and further developing the corporate bond market was truly encouraging. We appreciate BSC's continued efforts in strengthening this ecosystem. Thank you once again. And with this, ladies and gentlemen, we come to a key moment of today's inaugural program, the moment that captures the spirit, the purpose, and the promise of the bond market outreach initiatives. The OBPP tagline represents a shared commitment of the regulator, market institutions, and stakeholders to deepen India's bond markets and widen participation through awareness, trust, and transparency. May I kindly request all of you to please put your hands together as I invite the chairman of SEBI, Shri Tuhin Kanta Pandey, on the stage for the same. Let's welcome him with a thunderous round of applause, everybody. We would like to welcome him with a lovely bouquet of flowers. May I request Shri K. Sarvanan to join us back on the stage to present the bouquet to Shri Tuhin Kanta Pandey. A very, very warm welcome to you, sir. I would also like to invite Shri Amarjeet Singh, whole-time member of SEBI, Shri Sundar Raman Ramamurthy, Managing Director and CEO of BSC, Shri Ashish Kumar Chauhan, Managing Director and CEO NSE, and Ms. Maninda Chima, Executive Director, SEBI. Also, I'd like to invite on the stage the representative of OBPP, Aditi Mittal. She's also a managing director of AK Group and a co-founder of India Bonds. A very, very warm welcome to all our dignitaries. Ladies and gentlemen, we are now proceeding towards the official launch of the OBPP tagline. May I please have the remote on the stage? Requesting Shri Tuhin Kanta Pandey to kindly press the button on the remote to launch the tagline. Requesting the dignitaries to kindly turn towards the screen. All of you, please. Thank you. Thank you so much. Requesting Ms. Aditi Mittal, Managing Director of AK Group and the co-founder of India Bonds, to present the memento to our dignitaries, beginning with Shri Tuhin Kanta Pandey, Chairman of SEBI. May I request Ms. Aditi to present the next memento to Shri Amarjeet Singh, whole-time member SEBI. Ms. Aditi will now present the memento to Shri Sundar Raman Ramamurthy, Managing Director and CEO of BSC. Next, we would like to present the memento to Shri Ashish Kumar Chauhan, Managing Director and CEO of NSC. Next, I'll request Ms. Aditi to present the memento to Ms. Maninder Chima, Executive Director, SEBI. And I will request Ms. Maninder Chima to present the memento to Ms. Aditi Mittal. Thank you. I will now request all our dignitaries to kindly take the mementos in the hand and pose for the group photo. Thank you. Thank you, everybody. You may now take your seat, requesting Shri Tuhin Kanta Pandey to stay back with us on the stage to launch the documentary video highlighting the objective and the vision of the Bond Market Outreach Initiative. Can we have the remote?
The bond market story. Bonds, among the oldest financial instruments, continue to fund growth with trust and transparency. The story of bonds is millennia old, from clay tablets recording early loans in 3000 BC in ancient Mesopotamia to classical Greece and Roman kingdoms, and across continents and centuries, societies have relied on structured debt to build trade, infrastructure, and institutions. India's journey mirrors this evolution, from colonial-era loans to post-independence government securities that built our modern economy. Over the past 2 decades, India's debt market has evolved, transforming from a bank-dominated system into a rapidly expanding, diversified marketplace. The value of corporate bonds outstanding have grown exponentially from about 17.5 trillion in FY15 to over 53 trillion in FY25, with FY25 seeing record issuances of nearly 9.9 lakh crore. At roughly 16% of India's GDP, our corporate bond market still has room to grow compared to developed economies, but the direction is clear. and the momentum is real. Today, the investor base has broadened well beyond traditional institutions. Mutual funds, insurers, pension funds, NBFCs, and now a growing base of retail investors, all empowered by digital access. This increase in participation is accompanied by a broader range of issuers and instruments. Capital now flows across financial services, infrastructure, energy, manufacturing, and green finance, with bond types expanding to ESG-linked, social, and sustainability-linked debt aligned with global standards. Behind this rapid transformation stands India's regulators reshaping accessibility, liquidity, and protection in the bond market. That intent is now visible on the ground. Important measures in recent times include reduction in private bond face value to 10,000, UPI-based public debt applications enabled up to 5 lakh, boosted municipal bonds via platforms, launched electronic debt bidding platform for transparent price discovery, created centralized corporate bond cash flow database, strengthened tri-party repo for liquidity efficiency, and introduced liquidity window facility for early corporate bond exit. For issuers, the debt market is a thriving ecosystem offering potentially lower cost of capital, longer tenors, diversified funding, and access to a broad investor base. The numbers itself reflect the shift. Between FY22 and FY24, about 22 lakh crore was raised through corporate bonds, comparable to around 25 lakh crore through bank credit, signaling real depth and confidence. In truth, India's bond market is more than just a financing tool. It is the wheel of continuous growth and engine of national progress. For investors, especially those with a fixed income mindset, bonds offer predictability, stability, and meaningful diversification, turning savings into long-term security. This accessibility means as ticket sizes fall and digital access rises, more Indian households can move from a savings mindset to thoughtfully investing in the bond market, joining the nation's growth story. A deeper bond market channels domestic savings into roads, ports, power, healthcare, and digital infrastructure, reducing dependence on foreign capital and building resilience. And as India moves towards Viksit Bharat 2047, we are poised for the next decade of growth under the able leadership of SEBI. Bonds. Ek Sashakt Bandhan.
And now continuing with the launch initiatives, we will present the series of investor awareness videos developed by BSc and NSC. May I once again request Sri Tuhin Kanta Pandey to kindly inaugurate these videos.
अरे यार, ग्रोसरीज भी इतनी महंगी हो गई।
वेलकम टू अडल्टहुड। चलो बिल स्प्लिट करते हैं।
स्प्लिट तो हो जाएगा, पर लगता है पैसे बस आ रहे हैं और जा रहे हैं।
हाँ, सिर्फ खर्च नहीं, इन्वेस्ट भी करना पड़ेगा।
वही तो, इक्विटी, म्यूचुअल फंड्स के साथ ही आजकल कॉर्पोरेट बॉन्ड्स में भी काफी लोग इन्वेस्ट कर रहे हैं।
वो तो करेंगे ही ना। कॉर्पोरेट बॉन्ड से फिक्स्ड इनकम जो मिलती है।
तुम्हारा मतलब अश्योर्ड रिटर्न्स?
नहीं, फिक्स्ड इनकम एट रेगुलर इंटरवल्स। और इसमें इन्वेस्ट करने से ओवरऑल पोर्टफोलियो का रिस्क भी कम होता है और डाइवर्सिफिकेशन बेनिफिट्स भी मिलते हैं।
इनफैक्ट कॉर्पोरेट बॉन्ड होल्डर्स को शेयर होल्डर्स के कंपैरिजन में प्रायोरिटी मिलती है अगर कंपनी डिसॉल्व या बैंड हो जाए।
और इसके रिस्क्स?
देखो, हर एसेट की तरह कॉर्पोरेट बॉन्ड्स में भी रिस्क्स तो हैं। जैसे अगर कंपनी की फाइनेंशियल कंडीशन सही नहीं है तो तुम्हें फाइनेंशियल लॉस भी हो सकता है। इसे अवॉइड करने के लिए बॉन्ड इशुअर की रेटिंग चेक करो।
जैसे खाना ऑर्डर करने से पहले रेस्टोरेंट की रेटिंग चेक करते हैं?
बिल्कुल। इसके साथ ही लिक्विडिटी रिस्क भी देखो,
क्योंकि कुछ कॉर्पोरेट बॉन्ड्स इजीली नहीं बिकते, तो उन्हें बेचने के लिए प्राइस के साथ कॉम्प्रोमाइज करना पड़ सकता है।
और जब मार्केट में इंटरेस्ट रेट्स बढ़ते हैं तो पुराने कॉर्पोरेट बॉन्ड्स जिनका इंटरेस्ट कम है उनकी वैल्यू गिर जाती है, तो ऐसे में तुम उन्हें सेल नहीं कर पाओगे।
मतलब कॉर्पोरेट बॉन्ड्स लेने से पहले इन रिस्क्स का ध्यान रखना है?
बिल्कुल। प्रोडक्ट कोई भी हो, इन्वेस्ट हमेशा सोच समझ के करना चाहिए।
फाइनली यार, सैलरी आ गई। सोच रहा हूँ इस बार थोड़ा ढंग से इन्वेस्ट करूँ।
ग्रेट आइडिया यार। तो क्या सोचा है?
देख, ऑप्शंस तो काफी हैं, इक्विटी, म्यूचुअल फंड्स, फिक्स्ड इनकम इन्वेस्टमेंट, पर क्योंकि आई एम लुकिंग फॉर अ प्रोडक्ट विद अ रिलेटिवली प्रेडिक्टेबल इनकम, फिक्स रिटर्न वाले किसी ऑप्शन में इन्वेस्ट करने की सोच रहा हूँ।
तो किसी फिक्स्ड इनकम इंस्ट्रूमेंट में इन्वेस्ट कर, जैसे कि बॉन्ड्स।
पर इन्वेस्टमेंट इन बॉन्ड्स तो थोड़ा कॉम्प्लिकेटेड होता है ना?
नहीं यार, कौन सी सदी की बात कर रहे हैं? नाउ यू कैन इन्वेस्ट ऑनलाइन इन बॉन्ड्स एट अ क्लिक ऑफ अ बटन थ्रू वेरियस प्लेटफॉर्म्स लाइक ऑनलाइन बॉन्ड प्रोवाइडर प्लेटफॉर्म, मतलब OBPP। यहाँ पे तुझे वैरायटी ऑफ बॉन्ड्स मिलेंगे टू इन्वेस्ट, इंक्लूडिंग कॉर्पोरेट बॉन्ड्स, गवर्नमेंट बॉन्ड्स, PSU बॉन्ड्स एंड अदर फिक्स्ड इनकम ऑप्शंस।
Oh, that sounds great. I think I'll start.
अरे अरे अरे, पर पहले keep two things in mind. First, only invest as per your risk appetite. Second, invest करो only through SEBI regulated OBPPs.
Best है. I think now I have the clarity.
बॉन्ड एक सशक्त बंधन है, इसमें अपने प्रोफाइल और चॉइस के हिसाब से इन्वेस्ट करो।
इसका कॉल फिर से आ गया।
क्या हुआ?
जब से कॉर्पोरेट बॉन्ड्स लेने का सोचा है ना,
तब से अलग अलग लोग कॉल कर रहे हैं, समझ नहीं आ रहा क्या करूं।
देखो, कॉर्पोरेट बॉन्ड्स लेने से पहले कुछ चीजें इंश्योर करनी होती हैं। जैसे सबसे पहले ये कंफर्म करो कि कॉर्पोरेट बॉन्ड का रिस्क लेवल क्लियरली एक्सप्लेन्ड हो। फिर डिसीजन लेने से पहले प्रॉपर टाइम लो। अगर कोई जल्दी डिसाइड करने का प्रेशर डाले तो थोड़ा रुकना बेटर होता है। इसके साथ ही इन्वेस्ट करने से पहले फीस, चार्जेस और एग्जिट के टर्म्स क्लियरली समझ लो। लास्ट में ये भी देखो कि रिकमेंडेशंस तुम्हारी इनकम, गोल्स और रिस्क एपेटाइट के हिसाब से है या नहीं।
अच्छा, मतलब ये सब चीजें पहले से चेक करनी पड़ेगी।
बिल्कुल। कॉर्पोरेट बॉन्ड्स लेने से पहले डिटेल्स लो, रेटिंग चेक करो और बिना प्रेशर के डिसाइड करो।
हाँ, चलो अब कॉर्पोरेट बॉन्ड्स में इन्वेस्ट करते हैं।
रिया, ये देख, क्या इन्वेस्टमेंट अपॉर्चुनिटी है यार।
क्या अपॉर्चुनिटी बताएगा भी? किसी ऐसे वैसे सेबी अनरजिस्टर्ड प्रोडक्ट में मत इन्वेस्ट कर देना बस।
तू भी ना, कॉर्पोरेट बॉन्ड्स हैं, 20% रिटर्न्स गारंटीड। तू ये देख, ऐड पे भी लिखा, डाउनलोड दिस ऐप एंड गेट द फिक्स सेफ इन।
20% फिक्स्ड इनकम और वो भी सेफ।
हाँ, ऊपर से मैसेज पॉपअप भी आ रहा है, लिमिटेड टाइम ऑफर, इन्वेस्ट फास्ट। मतलब पूरा यूनिवर्स मुझसे यस कह रहा है।
खुद से मैंने कितनी बार कहा है, नो इन्वेस्टमेंट इज कम्प्लीटली रिस्क फ्री, और ये तो सुनने में मुझे वैसे हाई रिस्क इन्वेस्टमेंट लग रहा है। अपना रिस्क प्रोफाइल समझ के इन्वेस्ट करना।
हाई रिस्क इन्वेस्टमेंट तुझे क्यों लग रहा है? सब ठीक तो लग रहा है यार, मुझे तो ऐप भी जेन्युइन लग रहा है ना।
अरे ऐप के लुक के बहकावे में मत आ। लेट मी शो यू हाउ टू स्पॉट दीज स्कैम्स। सी, द गोल्डन रूल इज टू वेरीफाई द प्लेटफॉर्म, यानी सेबी रजिस्टर्ड है भी या नहीं।
वो कैसे?
देख, सबसे पहले विजिट सेबीज ऑफिशियल वेबसाइट, क्लिक ऑन इंटरमीडियरीज और मार्केट इंफ्रास्ट्रक्चर इंस्टीट्यूशंस। फिर you can check the name of the platform on the recognized intermediaries section or online bond platform provider section. Okay? Then look for the registration code and confirm if they are registered with any stock exchange.
और ये हाई रिस्क क्यों लगाते?
Not all the bonds are same rule. They differ in terms of risk based on ratings. Higher returns can mean low ratings, which can also mean higher risk.
ओह,
और by the way, ये तो unregistered निकला, नाम ही नहीं है लिस्ट में।
बच गया। मैंने तो ऑलरेडी गोवा के प्लान्स इमेजिन कर लिए थे।
नेक्स्ट टाइम किसी भी बॉन्ड या फिक्स्ड इनकम इन्वेस्टमेंट्स में इन्वेस्ट करने से पहले जस्ट रिमेंबर टू वेरीफाई द प्लेटफॉर्म ऑन सेबी वेबसाइट।
पॉज, वेरीफाई एंड देन इन्वेस्ट।
Well, now, ladies and gentlemen, it's my privilege to request Shri Tuhin Kanta Pandey sir to deliver the inaugural address. Can we please have a big round of applause for him, everybody? Over to you, sir.
Shri Amarjit Singh ji, WTM SEBI, Shri Ashish Kumar Chauhan, MD and CEO NSE, Mr. Sundar Raman Ramamurthy, MD and CEO BSC, leaders of India Inc., market intermediaries, ladies and gentlemen, very good morning. So today we are bonding on bonds. I'm delighted to address this inaugural outreach program on corporate bonds. We are meeting today for a primary purpose, which is to hear directly from issuers what keeps you away from accessing the corporate bond markets and what will make it work better for you. This is a time when India is embarking on an ambitious and aspirational journey towards Viksit Bharat. For this goal, our capital markets must not just keep pace, but must lead the way. The growth we are aiming for cannot be financed by bank credit alone. To fund our infrastructure push, green transition, manufacturing capabilities, and service excellence, we need a strong banking system complemented by a deep, liquid, and trusted capital market. Today, I will highlight how corporate bond markets can support India's next phase of growth and why this outreach matters. India remains among the fastest growing major economies. Over the past 3 years, quarterly GDP growth averaged about 7.8%, and real GDP is estimated to grow at around 7.4% for FY26. We are now the world's fourth largest economy and poised to enter the top three soon. The corporate bond market has become increasingly important. My previous speakers have spoken a lot about it, but at the risk of repetition, I would also narrate certain facts. In FY25, issuers raised about 10 trillion rupees through debt issuances. Between April and December 25, also they have raised about 6.8 trillion rupees. Over the last decade, outstanding corporate bonds have grown at roughly 12% CAGR from about 17.5 trillion in FY15 to 58 trillion at end of December 2025, which means 58 lakh crore. These amount to around 60% of bank credit to industry and services. Even so, corporate bonds outstanding amount to only about 16% of GDP. By comparison, this figure for South Korea is around 79%, for Malaysia 54%, and China 38%. Despite the corporate bond market growing significantly, the issuer base remains narrow. While more than 5,600 companies are listed in equity, only about 770 entities have raised funds through the debt market. Of these, 272 have issued debt multiple times, while many have issued debt only once or twice. Capital market participation is rising, as you know. The number of unique investors has grown from 43 million in FY20 to 139 million today. Yet, SEBI's investor survey shows awareness of corporate bonds as an investment product is only about 10%, well below deposits, insurance, and small savings. Even cryptocurrency has higher awareness at 15%. A well-developed corporate bond market gives corporates an alternative to bank borrowing, especially for long-term funding. It diversifies risks beyond the banking system and can help bring down cost of capital for corporates. For retail investors, corporate bonds offer portfolio diversification beyond equities and bank deposits. Access through regulated products and platforms can help households participate in fixed income securities with clear disclosures and stronger investment protection. So the question is not whether India needs a deeper bond market. It does. The question is, why are many capable issuers still not choosing this route to raise debt. The current market structure is heavily skewed towards highly rated issuers who account for 85 to 90% of all bond issuances. Additionally, nearly 60% of the products of the funds raised are by financial institutions rather than a diverse range of industries. This concentration limits the choice available to investors and restricts fair price discovery across different sectors of the economy. The secondary market remains shallow because institutional investors follow a buy and hold approach rather than active trading. This is compounded by the dominance of private placements, which can reduce transparency and make it harder for smaller issuers to access the market. Retail participation in corporate bonds remains extremely low, nothing as compared to equity markets. But these are only the visible symptoms. This outreach is meant to decipher the practical reasons, cost, time, documentation, ratings, investor feedback, disclosure expectations, listing frictions, and post-issuance obligations that influence your choices, means the choices of the issuers. SEBI's approach is optimum regulation. Fewer, smarter rules that ease doing business without compromising market integrity. Let me briefly highlight some measures taken to strengthen the bond markets, and they have also been in the video that you had, that the minimum investment threshold has been reduced from 1 lakh to 10,000 to widen retail access. Online bond platform providers enabled to facilitate online bond transactions. Issuers permitted to offer incentives, additional interest, or an issue price discount to specified investor categories. On the developmental side, as you know, we have looked at market infrastructure enhancements such as electronic book provider and request for quote platforms. NSE chairman, CEO spoke about them. Also, BSC CEO also mentioned about several enablers that can be brought in further. A limited purpose clearing corporation has been brought in for repos in corporate bonds. This was done launched in January 26. It cleared trades worth 770 billion rupees. A liquidity window facility is introduced to allow investors to sell bonds back to issuers pre-maturity. But we need more takers, more issuers to lean on this particular facility. A corporate debt market development fund has been created to provide support during stressed bond markets. We have relaxed the threshold for identifying HVDLEs, which was mentioned by Mr. Amarjit Singh in his inaugural remarks, thereby easing their compliance requirements. Collectively, these measures are deepening the primary and secondary markets and building the foundation for a larger, more liquid corporate bond markets. So what's the way ahead? The way ahead is a shared responsibility for all of us. Regulation alone cannot build a market. The next phase depends on issuers, investors, intermediaries, stock exchanges, and regulators moving together. These outreach programs are a listening exercise to identify constraints and prioritize solutions. We want to understand what has kept you from accessing the bond markets. What part of the process do you find challenging? Ratings, documentation disclosures, listing, or post-issue compliances? What would make your choice public issuance over private placements? Why do some issuers return to the bond market repeatedly while many issue once and do not return. What changes would meaningfully improve secondary market liquidity? Your feedback will help us to refine the framework, strengthen market infrastructure, and expand issuer and investor participation. SEBI, in coordination with MIIs and OBPPs, will run a comprehensive bond awareness program to improve financial literacy, transparency, and retail participation. Online bond platform providers have a key role to play in widening retail participation by making access to corporate bonds simple, transparent, and comparable. You must guide investors on product suitability, make them understand key risks through standardized disclosures, and reduce information gaps. The recent union budget has proposed a series of reforms for corporate bonds to address the shallow liquidity in the secondary markets. As mentioned before, a market-making framework will support continuous two-way quotes, reduce bid-ask spreads, and improve price discovery, thereby making corporate bonds a more reliable asset class for investors. Derivatives on corporate bond indices and total return swaps will help investors in efficient risk management. As secondary market liquidity improves and investor base widens, the corporate bond markets will become more reliable and cheaper funding route for issuers. We look forward to engaging with all stakeholders to implement these proposals. In conclusion, I invite you to use these outreach programs to share your views with us. Please share not only what is difficult, but also what would make the bond route easier, faster, and more predictable. Our aim is simple: to make corporate bonds a mainstream funding option and an investment avenue for all classes of investors, not a niche option used by a few. Let us work together to bring more issuers to the bond market, provide more options for investors, and support India's growth story. Thank you. Jai Hind.
Thank you very much, sir, for this highly insightful address. Your guidance today has added immense value to this inaugural program. Also, most importantly, the message of shared responsibility where regulators, exchanges, issuers, and market participants will work together has given a meaningful direction to all of us. Thank you once again. And with this, ladies and gentlemen, we will now take a short tea break of 10 minutes, requesting all of you to please resume back at 11:40. Thank you.
hey, hey, check, hey. Check, hey, hey. Check, hey, hey, hey. Check, hey, hey, hey. Check, hey, hey. Check, hey, 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 hey. Check. Check, check, hey. Check, hey. Check, hey. Hello, hello, hello. Hello, hello. Hello, 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 hello. Check, hey this. Check this. Hello, 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 hello. Check, hey this. Check, check, hey. Check, hey this. check. Hey, test. Check. Hey. Check. Check. Hey, test. Check. Hey.
Check test. Ladies and gentlemen, requesting everyone to join us back. You can you can take a cup of your coffee, tea inside, settle down as we're about to begin with the panel discussions. Ladies and gentlemen, may I please request all of you to join us back? You can carry the cup of tea or coffee inside the ballroom, settle down so that we can start on time. Requesting all of you to help us keep this conference on time. Ladies and gentlemen, it's 11:53. We have to start with our first panel discussion. May I please request everybody standing outside in the pre-function area to join us inside, settle down. You can take a cup of tea, coffee inside, and please come inside and settle down. Can we ring a bell once again? Meanwhile, I would just like to check if all the panel members are here. Ami? All panel members are here? Requesting all the members to settle down. We're about to begin with the first panel discussion. The topic of this panel discussion is the fundraising avenues through debt securities. I would like to invite on the stage our panel members, beginning with Mr. Dinesh Pant, Managing Director, LIC of India. He brings over 35 years of leadership across insurance, investment, actuarial strategy, and risk management. A fellow of the Institute of Actuaries of India and UK, he played a pivotal role in LIC's landmark 2022 IPO and has deep experience in ALM, actuarial governance, and long-term investment. A very, very warm welcome to you, sir. Next, I would like to invite on the stage Mr. Raj Kiran Rai, Managing Director of NAPFID. Ladies and gentlemen, he's a veteran banker with nearly 4 decades of experience. He earlier served as MD and CEO of Union Bank of India, where he led one of the country's largest bank amalgamations at NAPFID. He plays a central role in shaping long-term infrastructure financing for the nation. A very, very warm welcome to you, sir. Next, I would like to invite on the stage Mr. Virendra Bansal, Managing Director and CEO of SBI Caps. He brings over 35 years of leadership across credit, international banking, and large corporate relationships. He has previously served as SBI's country head for the US, CEO of SBI New York branch, and vice chairman of SBI California, and has handled multi-billion-dollar corporate exposures in India. Next, I would like to invite on the stage Mr. Subodh Rai, Managing Director of CRISIL Ratings. Ladies and gentlemen, an IIM Ahmedabad alumnus with over 27 years of experience in credit rating, risk management, and analytical leadership, he has served as Chief Rating Officer and President, Risk and Compliance at CRISIL, and is a member of SEBI's Corporate Bonds and Securitization Advisory Committee. Next, I would like to invite on the stage Mr. Gaurav Kumar, founder and CEO of UB Group. Mr. Gaurav Kumar is the founder and CEO of UB Group and a pioneering debt tech platform transforming India's institutional and retail debt ecosystem. With over 18 years of experience in structured finance and fintech, he has built UB into a platform facilitating over 1,40,000 crores in debt volumes, connecting 17,000 enterprises and 6,200 lenders. And now I'd like to invite on the stage our moderator for this panel, Ms. Maninda Chima, Executive Director, SEBI. She brings over 26 years of regulatory leadership across market regulation, investment management, corporate debt markets, surveillance, enforcement, and international affairs. She has represented SEBI in several RBI, ASCO working groups. A very, very warm welcome to you, ma'am, and over to you.
So, I think we are just starting around noon, so I'll wish all of you a very good afternoon. Um, since morning, we have heard some very profound and deep thoughts, and also heard a lot of facts on corporate bonds. And drawing from whatever we have heard in the morning, we will proceed straight away to this discussion with a few observations. Our bond markets have grown, but they are dominated by the financial sector, NBFCs and other entities, insurance companies, REITs, in which. So, and the corporate borrowers, whoever are there, tend to be largely AAA rated. So the challenge we are facing when we are wanting to expand the bond markets is to go beyond these set of issuers who repeatedly come to the bond market and who have been expanding it as the demand for finance has grown in the country. The second challenge is there are two ends of the bond market. One is the long tenor infrastructure type of financing. So where the tenor is very large and the expectation is more from institutional investors. And then there is the other end of the market, which is shorter tenure, where people are willing to take a higher risk, but for a shorter period. And this is where we hopefully expect corporates to come in to tap the bond markets. But the question which I want to place before the panel members is, what is in it for corporates to come to the bond markets? Why should they come, and what are the challenges they face? And the perspectives will vary based on the type of issuer which is going to come. And so I'll start. I think I should start first from the rating agency side, right? So, and then we can take it with the institutional investors, and we'll come to the perspective of the debt platforms towards the end.
Thank you, ma'am. Good morning, everyone. First of all, why this A-rated issuer should come to the bond market? Very relevant question. I think there are multiple advantages for them. First and foremost is diversification in terms of resource raising. What we have seen in the past is that there may be time when bank may also come under stress. I remember a time when good number of banks were under prompt corrective action. If you are diversified, if you're not able to raise funds in the bank, bond market is there. So it's very important that you're present in the bond market. And it also in a way gives pricing advantage, because there are times when bond may be very competitive. There are times when banks may be offering very competitive rate. If you're already present in both the markets, you'll be able to ensure that you're getting optimal interest rate. So that's very important. Another thing that I have noticed is that in general, the transmission of interest rate in bond market is much faster compared to banks. So that is another benefit that can be reaped. And if you're one of those frequent issuers in the market understand you well, they trust your governance. We see the interest rate on the bonds for a particular issuer keeps on coming down and it goes closer to the market pricing. So these are the benefits a bond market, a rated issuer can get if they access bond market. Challenges, if you ask me, ma'am, there are a big challenges. Of course, we have investors here. I think many of the investors for multiple regions, that they are not investing much in A-rated papers. If I look at long-term, patient capital, whether it is pension funds or if it is insurance, there are regulatory caps that is there, which is hindering. If I look at mutual funds, somewhere, they have not come down the curve. So that is a challenge that we see from investor side. But if you look at overall pool, ma'am, I mean, just talking about CRISIL, we rate around 1,300 plus A-rated companies. And just to give you a flavor about their credit strength, if you look at median interest coverage for these entities, it is around 8 to 9 times, which is material and substantial. If you look at the leverage, which is essentially debt equity ratio, it is around 0.3 times. It means these companies are very well capitalized. And we also track their performance during the COVID to see what kind of pressure they see. And we realized there's hardly any downgrade. They were very, very resilient corporates. Their performance was great. So I think this can be a great opportunity for the investors if they start looking at A-rated companies.
Thank you, Mr. Rai. Now I ask Mr. Virendra Bansal from SBI Caps to give his perspective on why should an investor come to the corporate bond markets? Why should an issuer come to the corporate bond markets?
So Mr. Rai has covered a few things. One more thing which is very important in bond market is that today you are fixing your interest liability. In bank loans, it varies. So let's say you are taking a 10-year kind of a loan or a bond. So bank interest rates will move. They'll be linked to some external benchmark or internal benchmark. Whereas in case of bond, your costing is fixed today itself. So when you are doing the IRR for your project, you can build in the interest cost straight away upfront. So you know exactly what you are getting into. Second advantage is it can be more structured. You could say, I'll pay quarterly interest, I'll pay annual interest, or I'm going to redeem some portion every 3-4 years, or I'm going to redeem at maturity. So all that, depending on the cash flow from your projects, you could structure the repayment schedule as well. It's a huge flexibility which gives to the issuer as compared to bank loans. The biggest challenge in my view would be that in case your rating gets upgraded, bond market doesn't give you any benefit of that. Your bond rally, investors benefit, but you can't really cut your interest cost. If you want to buy it back, if it is permitted, you have to make whole, so the cost for you remains the same. In case of bank loans, it is more flexible for you. You could repay, refinance, ask for all those kinds of things. So bank loans give you a more flexibility, but at the same time adds more complexity. Bond market is simpler, gives you upfront what it is, but you have to live with that for the duration of the bond. So the challenge is this only, man, that you need to be very careful of what you want to do with that money. So there is no option really to go out of the bond as long as it is alive.
Thank you for this perspective. And now I invite Mr. Rajkiran Rai to give his perspective on why should issuers come to the bond market and what are the challenges they face.
Actually, raising money through bond market, there are two important things for a corporate. It is a better cash flow management and better interest rate management. Actually, again, there are two reasons why they raise money. One is regular working capital requirements. Most of the financial institutions and all that, they do for that. And some general purpose loans from the corporates also happening there. I will touch on the other area, which is basically asset backed and long-term bond market. Now, actually, when people invest in long-term projects, the IRRs are already generally factored in, with a particular interest rate. So I had a very interesting case of a solar asset company which was looking for a 17-year fixed rate loan. They didn't want to issue a bond, but then they said, can you give? And we are capable of doing it, we did that. So actually there are different perceptions about corporate also, because they want to lock their returns. Because actually when the cash flows are fixed over a period of time, so interest rates can fluctuate. So when you go for a typical bank loan, it can vary every 3 months, 6 months, 1 year, and we have seen enough cycles. Now we may be at the lowest point, but we don't know after 1 year what will happen. So there is a refinance risk and there is an interest rate risk. Whereas bond market takes away that. Because if you issue a 10-year or 15-year bond, your interest rate is fixed, you can plan your business. And again, your cash flow management, you can amortize over a period of time, you can make it, one shot payment at the end. So it is all structured based on your cash flow. That's why we are seeing more and more InvITs actually issuing bonds that AAA rated, a lot of traction in that long-term bonds, because they also keep a mix of loans and bonds, so they balance their risk well. And what they're doing actually, they're increasing their IRR, the returns what they give to the investors. Incidentally, most of these the investors sitting behind them are insurance companies and pension funds, which are international players basically, where we don't see our own insurance companies and pension companies sitting there. And the assets are all our road assets, energy assets and all that sitting with our own assets. But then they're making very, very decent returns by mixing these two. So this is the important, and there is a big domain actually, as per our assessment, even infra bonds of BBB and A rated companies can go up to 6 lakh crore. This is a rating domain I am seeing. They are rated, but they're rated BBB and A with proper credit enhancement, with proper pricing and proper spread of the risk actually from various players. So this can increase the yield for insurance and pension companies by at least 200 basis points from what they are getting today. So there is a risk reward.
Thank you so much for giving a very clear indication of the role which rating and risk and reward plays in bonds. And now I want to ask Mr. Dinesh Pant, as an investor, what would it take for you to start investing into a higher return, but also a lower rated bonds? We understand there are regulatory constraints, but uh, uh, putting aside regulatory constraints, what is it that stops institutional investors, or what is it which would attract institutional investors to look into lower rated bonds? And is credit enhancement a good enough solution, or even that might have face some hurdles?
Yeah, thank you. Uh, the basic question is that, as an investor, is it it's my choice or my need that I need these issuances to be in place? Answer is yes. That it's not that we have it's voluntarily we do not want to get into this corporate bonds or everything. In fact, to the first question which you asked about, it makes a lot of sense for corporate issuances to come in form of corporate bonds, because the risk premium which is required for the equity is much higher than what would be expected for the issuance of the corporate bonds. As long as the debt equity ratios are within the control, it makes all the sense for corporates to come into this thing, unless they are over leveraged. From the purchaser point of view, the point which is talked about is that, and I was jokingly asking about is, see, because the structure, the way the structures of the large institutions work, there is a safeguard, this mindset, because we are largely working for the policyholders of protection, which becomes the underlying most important thing. It is not only the return on money, but return of money which becomes very important also, because you lay down certain policyholders' reasonable expectations. So the chances of erring on default becomes big risk. But the issue is that whether we will be going for low rating, one, the constraints come in form of regulatory, prescriptions in order to protect things. And then, as you rightly mentioned about, what are the risk mitigation structures which have been created around the lower ratings? So credit enhancements or other way possibly debt coverage, this escrow mechanisms to be in place, some sort of rating down related, the put and call options being structured. Possibly the solutions would come around, and through the innovative product designs also being available. In fact, if we look into this aspect, I personally see how to balance it is the mezzanine type of bonds which are available globally, where unlike the most prevalent structure of fixed coupons being the structure, certain coupons being there, and the balance portion being facilitated through the performance of the companies can be a good solution. That's why possibly the interest toward REITs and InvITs is increasing as compared to the vanilla type of corporate bonds. So I think we need proper risk mitigation and an environment in which these things are encouraged, and credit enhancement has to play a big role in it.
Thank you so much for your perspective. And now I would invite Mr. Gaurav Kumar to give perspective from OBPP side. Now, our understanding is that OBPPs are in touch with smaller corporates and are wanting to participate in bringing them into the corporate bond space. So from your perspective, what are the kind of investors you are looking at while bringing such issuers? So both sides, if you can cover.
Sure, ma'am. I think if I just grade it out, right, and if I just make it a little bit more nuanced, so if you look at close to around 13 lakh odd corporates, out of 13 lakh odd corporates, as of last month, 4.3 lakh corporates have debt, right? And very few come to the bond market. And those who come are largely financial institutions because they are born to borrow. Corporates are not born to borrow. They only borrow if they have a specific need. And below a certain rating, you don't see too many issuers coming in, right? Why? As far as, and some of it we saw in the morning, I personally think, being in this market now for the last 20 years, we are genuinely at an inflection point. and what I call as the real UPI moment as far as bond markets are concerned. And thanks to SEBI, and I'll just outline three perspectives of what we are seeing from the issuer side. Because of the changes which we saw SEBI making, not only for OBPPs, but also for the AIF industry over the last 3 years, we have started seeing a lot of issuers who are below single A actually getting investors who can actually issue or subscribe to their issuance. So the challenge, ma'am, for the corporates was not that they were not very keen to come to the bonds market, but there were very few takers as far as risk premium and risk threshold and risk registered return was concerned. And that's why they were not really covered by a large part of providers of capital. So what we are seeing is a large pocket have been started getting covered by AIFs. OBPPs has been instrumental in terms of accelerating that kind of risk capital again. So where do we see that inflection point, ma'am? Today we see corporates which are A plus and below, very diversified asset class. What the bond market is giving them is the flexibility which some of my co-panelists covered. There are a lot of financing activity today which banks are not allowed to actually finance, because of which if you look at infra or you look at real estate, the cost of financing was very, very high, which has been significantly corrected by participating in the bond market. Now, what you are going to see, ma'am, is because of this entire inflection point and what SEBI has done for this entire sector through OBPP, AIF, etc., you're now seeing participation of family offices, you're seeing participation of ultra HNIs, and retail investors. Because if we believe that institutions can all of a sudden go from AAA, AA investing to single A and below, it might take a lot of time because of regulatory challenges or how they are themselves governed being institution. So if we have to build that two-sided risk curve, it is absolutely important that we also change the mix of investors who want to come into the bond markets.
Thank you for a very significant perspective on the kind of investors who can come in and take higher risk. From the investor perspective, one of the most important points is liquidity and ability to exit. And we've been, the budget announcement on market making has come in. So I would like the panel's perspective on are there thoughts on market making? I mean, there are questions on how would market making work. So I would like answers first from Mr. Dinesh Pant on what your expectation is from on the exit side. As an institutional investor, what is your expectation of a market making mechanism?
Yeah, actually, yes, liquidity is one of the important points. And if I say in context of we as a large investor, almost let's say 20% of my investment would be in equity for larger purpose of one, the extra differential spread that I want on my returns, and also liquidity. But it is not that from the current level going to the high level, let's say we are about 9 to 10% of exposure is in say corporate bonds. And out of the all issuance also, if you have got 56 lakh crores, our exposure in the corporate bonds would be around 9% or so of that. So within the available also, there's a lot of scope for, stepping up into this segment. Liquidity becomes big issue, but we are not looking at from the point of view only intervention or the participation of financial institutions. This market, if it has to grow up, the corporate bond market, the retail participation has also to become big. And the liquidity really becomes a big issue there. I tell you just an example. Similar to corporate bond issuances, insurance companies have a product which is called annuity products. Now, annuity products are similar to corporate bonds where you have to give certain returns at a particular period of time. They're supposed to be fixed. But the mindset of public has been that, they still want liquidity. So the purpose is to provide for a safe, fixed return so nobody can, take away that money. And insurance company had to bring in the concept of surrenders and provisions of withdrawal into that thing. So I think in order to bring about larger participation in these things, 2-3 things are very important. One, the availability of liquidity. For example, as we talk about certain corporates when they come out with certain issuances, one of the hindrances for a retail investor would be, in case I need money for my old age or for any, rainy times, where from I will get it money? If we can build in certain compulsory buyback portion of 5 to 10% being available, whether it is provided by the corporate or through market making arrangement, in which large institutions can play a part, they can be the provider of money, and these instruments can be taken back, and then we can also create hybrid structures in which they can participate and diversify. That will really help liquidity in the entire system, and liquidity is one of the important aspects.
Thank you so much for these inputs. And my question now is for Mr. Virendra Bansal to take this thought forward, that when an issuer comes, when a small issuer comes to the market, what is it that he can do, or what is it that he might be expected to do as far as providing liquidity is concerned, because that is what would attract the retail investor.
So, as Pansave just correctly mentioned, investors like him, the institution ones in India, are mostly buy to hold. So they may need liquidity, but that kind of nobody can provide to them. If they want to exit, nobody can really provide them. But for retail investors, absolutely essential. Without that, the market will not develop. So one thought is what Pansa was saying regarding a compulsory buyback or a put option of 10%, whether through the issuer or through an institution. So that gives a window to investors, at least for emergency, they can sell and get out if they want to. They may not do it, but they'll have a mental comfort that if I want money, I can get it out. So that's one. Second, which is again slightly important, is market making, what ma'am was mentioning too. That's the way forward. Now, the problem in the market making is that the brokers or the institutions who can do it in the debt market are very limited. In equity, the numbers are large. For example, SBI Capital Market, which I head, is not a QIB. So SEBI is not classified as under QIB. So I am restricted in doing so many things. So one is we to increase the pool of people who are allowed to be a market maker. So that's one. Now the second challenge, which is a bigger challenge, would be how do I fund it? So if I am a market maker today in SBI Capital Market, I have a limited capital, and then do I use it to buy and hold from the public those shares for market making? Because I may not get a exit. If I have bought while market making, I may not get the exit. So I have to hold it. So how do I fund it? So do I have a funding window available to me, like PDs, what RBI does, what they buy in the GSEC? The PDs go to RBI and get a funding. There can be a haircut, which is fine, but there's a steady money being available to market makers at a price which makes sense to them. So for example, if I'm buying a bond of 7%, I should be able to get a refinance at 6.5, then it makes sense for me. But if I have to pay 9% to borrow, I'm not going to do it. So that's one. So one is pool of money with the market makers. Second is how do they do it? A large number of participants which have to be brought in this system. And third is, ma'am, that can we have a mechanism where the issuer pays to market maker some remuneration? So all the three put together, whichever way, the cost of borrowing, the money coming from the issuer, then how does he exit, with how much he can hold. If we have this framework ready and large number of participants, then only market making can work.
Thank you for this. Taking this forward, my question now is for Mr. Rajkiran Rai on what is the cost of raising bonds for an issuer, taking into account cost of market making, taking into account the need for either credit enhancement or if one is accessing the market, the cost of public issue. So in your experience, how does the cost either encourage an issuer or discourage an issuer to use the bond market if it is to successfully work for both credit enhancement and market making?
Yeah, actually, issuer is not worried about how his bond is trading unless he's a regular issuer. That is why loading a cost to him for the for market making may not find acceptance with the issuers unless they are repeated issuers kind of thing. So they want to create a market. See, today SEBI has really modified the regulations in this way. Issuance is very smooth. The cost is also very low because like NAFID bond we issue, actually we have only 3 days now. Whether today we decide to raise money, third day the money will be in our account. It is so swift and all that, and the cost is also very low. So the original issuance of bonds is not a issue. The thing is now we are trying to correct the market because we want to increase the demand side. The more and more issuers come, and these concepts come when the retail investors are coming in, because the retail investor has to exit at 2 points. One is basically when they want liquidity, they think that they've made enough returns, they want liquidity, they want to exit. There are so many bond platforms which have evolved in last 2 3 years, which give enough adequate space for people to exit in the normal circumstances. In the bond market, we'll see some abnormal circumstances also. Abnormal circumstances when there is a risk of default, the issuer has like not paid interest, default on the interest and all that. That time there will be a huge flow of bonds for this thing. That is what we need to address. Actually, I think regular liquidity, I think the blunt platforms, like they're capable of addressing. Actually, we have seen this earlier also playing out. So, if you are able to give a confidence in kind of that kind of distress situations, that how you will give exit to this player at a price. See, somebody holding a bond at 100 rupees, risk, he is ready to exit at 60 rupees also because he thinks there is too much of risk. So it is only, vulture funds and some of the hedge funds only come in and buy at a very, very, we have seen this market. So that, can we build a mechanism in that kind of situation? Can we give a comfort? Because then, see what happens, the risk reward works accordingly. Because if you have to push people to issue bonds who are triple B rated or A rated, and they are giving a pricing which is 200 basis above the GSEC or above triple A, the thing is that investor who comes in will also see exit route because he has seen a heightened default chances here. That's why he is ready to take that risk. But at some point he has to have exit. That is how the expected credit losses model work. I think this can go to our CRISIL head also. And I think we need to think much deeper than the plain vanilla thinking of secondary market making. And if we are able to do that, we'll have investors, because we'll have investors at every cycle. With a sufficient haircut, there will be investors. But then that market has not evolved. And that is what we need to work.
Thank you for giving us, a direction to move in so far as product development as well as development of the type of investors is concerned. Now my question to Mr. Rai on insofar as mid-size issuers are concerned. What is your perspective from the rating side? All of them take ratings for the purpose of loans. Is that a fact? Okay. So what is it in terms of their experience with the process, including of rating, which would encourage them or which is stopping them today from going in this direction?
Let me share about the experience of mid-rated guys, and let's focus on A credit. To begin with, I mean, we started bank loan rating sometime in 2007-8. And it was a very interesting situation because if you look at banks, they were kind of comfortable if there's a delay of 10-15 days. As a rating agency, we are following single rupee, single day. So over a period of time, what we saw that this concept now is well embedded. Clearly, if I look at A-rated guys, we get, NDS, and clearly everybody is now following single rupee, single day, big change that has happened. Behavior-wise, if I look at governance-wise, also lots have changed. Because, initially, the question that we will ask, there will be a struggle to understand what we are saying. But over a period of time, we saw, okay, governance-wise, these entities are far better. And what we have seen I'll just say the default stats also for a rated pool. It was around 2% in the period of 2008 to 18. But if I look at last 7-8 years, the default rate has gone down from 2% to 0.7%. The period I'm talking about is 2015 to 25, that's the last ticket. So clearly, if I look at A-rated companies, our experience is that they're becoming stronger and stronger, a lot more resilient. I just quoted the number on interest cover and leverage also. I've seen their performance in COVID, which is once in a lifetime kind of event. And these companies were very well capitalized. Yes, we saw some stress on the business side because economy was under pressure, so demand were going down. But the balance sheets were so strong that we didn't see any significant default, we didn't see significant downgrade. In fact, these guys are really smart. Many of them were conserving cash. That was not going out of the system. So overall, if I look at A-rated corporates as a rating agencies, I think it's a fairly solid pool. I just want to add 1 or 2 points what Panji has said, and I kind of concur with him on liquidity side when he said some exit should be given. I think, as you rightly said, put option can be something that can be looked at for a portion, because if you say entire debt has to be paid at one go, that can create stress on these guys because these guys are not really big one. And if the concern is that can the rating go down? Answer is yes, rating can always go down for any issuer depending on business conditions. What probably in that case is that some rating link trigger can be explored that can give comfort to the investors. But as I see as a rating agency, ma'am, I think this A-rated companies, they have really evolved. And we are not seeing significant surprises in their performance. They've also become, I mean, in early days when we'll talk, okay, give me a projection. So it is a bit of a struggle. They will give us CMA that this year with the bank, and numbers will be like little optimistic, I will say, for the want of better word. But if I look at today, the number that comes is fairly reasonable in most of the cases. So my only point will be, as a rating agency, I can say, I mean, it's a very, very solid pool. Definitely, from investor side, I mean, they should be looking at this pool. And clearly, issuers also, as a rating agency, we do ask that, are you looking for bond market? Would you like to explore? A plus guys, many of them are doing CPs, ma'am, because there's some demand because they get highest rating if with good liquidity. But the moment you come to A and A minus, there's a bit of a struggle, and also they're a bit of a reluctance because they believe I have got a great relation with bank, so why should I even try this one? So that's a bit of a struggle. We explain them these are the advantages. That's the reason why they should be looking at.
So my takeaway from this is that the issuers need some hand-holding both from the arranger merchant banker side and also from the OBPP side. And I think my sense is that OBPPs are sort of being innovative in this space. So my question to Gaurav is whether, what is your view on your ability to handhold, if we can use that term, issuers, and what is it that would spook investors? Because if you bring a low-rated issuer to market and then there is a default, how do you feel it'll impact your investors?
Sure, ma'am. I'll just share the last 3 years of experience of what we are seeing on the issuer side, and a lot of thinking, like Mr. Rai said, is actually almost lack of awareness, ma'am. Right, and in fact, we are seeing that with corporates which are A-rated, A minus rated, and those myths are around significant cost of borrowing, right, in the bond markets compared to bank markets. Bank markets being more relationship driven. So if the company sees some minor shocks, right, the banks might be much more amenable to get through those shocks, whereas a capital market investor might not be very keen to look at some of the relaxation which you might see on covenants, etc. And the other aspect is around cost of issuance, right, which we have discovered has been actually the biggest myth, right? And as the co-panelist said, that again, credit to SEBI, there has been tremendous amount of ease of issuance, especially if you look at private issuance today. SEBI has done a phenomenal job now with relaxation of guideline, etc., which is now making it very, very simple. Last big myth, ma'am, which we need to demystify is the percolation of the entire SEBI guideline on systemically important debt raising companies in the public market, right? A lot of issuers today think that they still need to have X quorum of independent directors, women directors, and what needs to be done on the limited audit side. I think what will happen is with a graded regulation, right, which is coming in from SEBI's standpoint, where depending on how much capital market exposure you have as a issuer, right, like what we see with RBI today as systemically important, disclosure norms to, surveillance, I think that will give a lot of comfort to issuers as we are hand-holding them into the market. I think, as I said, the process on private placement is very seamless. Also, ma'am, 2-3 points on to your other question. What has also happened is that with the overall denomination changing, right, they are also seeing a lot of visibility which is coming to these corporates, right? So anybody who has come into the corporate market now, bond market, In fact, when maturity is coming in, OBPPs are actually getting a lot of demand on the same issuer where redemptions are now coming in, right? 2, 3 trends I will leave and I'll answer your second question. Why I think you will see a lot of secondary coming in the bond markets now, if I leave that thought with you. A lot of issuance which has happened in the last 2 years to 3 years by OBPPs in particular have been between anywhere between 18 months to 36 months of overall maturity, right? Retail investors today, because this is a new asset category, which is now getting established, any new asset category will see some degree of adoption. So we are today seeing adoption by retail investors investing in 18 months to 36 months. They don't want to take long-term exposure in bond markets. Second trend which we are seeing is the highest demand which is coming in today from retail investors is actually on bonds which have a residual maturity of 6 months to 9 months, right? And earlier days, ma'am, if a retail investor was actually holding a bond, she did not know if she had to sell, where to go, because the number of real intermediaries which are there are hardly any in the bond market. So with the sell option which OBPPs, 39 of them can provide, it will immediately give that option for a retail investor to come and explore that option to sell. Lastly, to answer your question on distress, what we are seeing now gradually as the market develops, a lot of space there, ma'am, has to be taken by the AIFs who are now getting into special situations, are getting into distress. We have seen last 1 year a lot of AIFs which are special situations doing refinance of bonds, right? Even from, I would not call hard retail investor base, but from ultra HNIs and family offices. So that trend has already started, right? Last piece from OBPP's perspective, and I think that's something which SEBI is been very forefront in terms of looking. Today, if we look at, ma'am, OBPPs, and as far as retail investors is concerned, where OBPPs can do better, the disclosures today are actually not rating linked as far as OBPPs are concerned. So as an OBPP, if I am putting out a triple B bond or a triple A bond, the disclosures are more or less the same, right? So if a retail investor is actually participating in triple B, how do we at least bring in little bit of more friction and awareness for the investor at that point of time to itself see that this bond is highly liquid, it carries significant amount of risk than what other bonds on the platform carry, so that the awareness at that point of time is very high when they are making that investment. So anything which is illiquid, significantly liquid, allowing some degree of more friction will make that degree of clarity, because I think like Mr. Rai was saying earlier, as we are going down the risk spectrum, right, definitely there will be some degree of challenge or shock which might come in the future. But what will happen over a period of time is it will significantly bring the overall rating to risk curve into the bond markets.
Thank you so much for a very comprehensive answer. We have, I think, just about close to end time. So I just want to summarize by saying that this is a market where there is a band from institutional investor to retail investor, and shorter maturity, smaller issuer to very long maturity, large issuers. But all are needed and to act together to survive and to bring in liquidity. And so the retail is definitely needed. This cannot just remain an institutional market. We from SEBI side have a lot of food for thought based on this discussion. And if the panelists agree, we can take a few questions from the audience as well.
Thank you. I'm Shailesh Pathak, Senior at Stock Exchange. Maninderji's first question about what is the incentive for issuers, and I'll, without naming names, I'll quote an example. There was a large company where I was associated, which had around crores, 10, 11,000 crores of debt for an infrastructure project. It got completed and de-risked, wanted to reduce the rate. Options were the green bond or the multilateral route or just going to banks and getting it refinanced? The answers that, I think a lot of you, but from the financial institution perspective, the CFO of an infrastructure company, she or he has an option of going to banks, going to do this. What is the real plus point of corporate bonds? And green bonds, we figured, would take at least 3 months. The multilaterals would take 1 year. Getting it refinanced through banks would take 1 week. So why corporate bonds?
One very quick answer, just the repricing which you see in corporate bonds, at least in our experience, because the corporate bond market is actually rewarding you, right, significantly in terms of repricing as the market gets more comfortable, which we don't see on the bank side, because the banks will obviously look at the last sanction and where they are in terms of their own MCLR. So repricing, I think, to my mind, has been the significant takeover.
Yeah, I can add because I'm a large player here. Actually, to the question, what is the advantage of issuing a bond? Actually, one is the pricing. Like today, if you look at, if you are a large infra player, assuming a AA rated at least, and you look at the SDL rates today, if you are doing a bond issuance of even 10-year plus, you are getting a price which is closer to SDL. Okay, that is one advantage. If you go to banks today, today's because there is a today bank loan rates and the bond market has moved in opposite directions, but it is a temporary phenomenon, it will correct. So you'll have a refinance risk and a repricing risk in every year. So in your cases, because you are backed by asset class which is going to give you a more or less fixed return, why you are taking interest rate risk? Like it is the exporter taking a risk on foreign exchange. He is not supposed to take it. He is supposed to cover it. So for a large player, for a long-term bond, you have to hedge your interest rate risk. And bond market offers you the best cover rather than going to a bank, because they will reprice it every 3 months, 6 months, 1 year. So I think that is one thing. Then the cash flow management. When you have multiple assets where the returns are spread over 10 to 30 years, depending on what asset you are holding, basically bond gives a very good flexibility to structure your repayments over a period of time to give the best return to your equity investors. Moment it is a bank loan, I was a banker for almost 4 decades. Every rupee you earn, I want it to be paid to the loan account. Bond market doesn't work like that. You'll have an upside always. So that's why there are a lot of advantages hitting the bond market.
Yeah, hi, I'm audible now, thanks. This is Shomik from ISEC PD. One of the very interesting initiatives in the corporate bond market has been the ARCL repo, which is a large lender against corporate bonds, where mutual funds are a large lender. I don't see too many banks on the stage, and I have only one insurance company on the stage. My question is, when would other institutional categories like insurance be enabled to come into this, sir? And how do you look at this overnight lending against corporate bonds and giving liquidity to corporate bond players?
Context of insurance companies' participation into it?
Yes, yes, sir.
Yes, definitely it gives an opportunity. But the only issue for insurance companies is one is the overnight management of the money, and from the long-term perspective. The context is that whether the insurance companies will get the appropriate spread over what is required for them. As long as there's a matching of that is there, insurance companies would always be interested into these sort of structures, as long as they get that required spread which they are looking.
Thank you, sir.
I think if that's all, we can close the panel discussion. And thank you so much to all the panelists for making for a very enlightening discussion. I hope the audience also got useful points out of it.
Thank you so much, ma'am. I would like to thank all the panel members, requesting all of you to stay back with us on the stage. May I request Ms. Radhakirti Vasan to please join us on the stage to present the memento to all the panel members as well as the moderator. May I request Ms. Radhakirti Vasan to present the first memento to our panel members? Yes. Radha ma'am, I'll request you to please stand in the center. And can we take one more group photo, please? Thank you everybody. Requesting you all to take a seat. We just need a minute for a quick setup of the stage for our next panel discussion. So our next panel discussion will focus on addressing liquidity concerns in the bond market. All right, ladies and gentlemen, let's welcome our panel members on the stage, beginning with Ms. Aditi Mittal, Managing Director, AK Group and co-founder of India Bonds. Ms. Aditi Mittal is a chartered accountant and has nearly 2 decades of experience in fixed income and credit markets and leads businesses across debt broking and digital bond platforms. She also serves as a national co-chairperson of ASSOCHAM's Corporate Bond Committee. A very, very warm welcome to you, ma'am. Next, I would like to invite on the stage Ms. Neepa Sheth, founder and director of Trust Group. Ms. Neepa Sheth is a chartered accountant with an All India rank 4th and a CFA chart holder. She has over 2 decades of experience in fixed income and capital markets. She currently serves as the chairperson of ASSOCHAM's National Council for Corporate Bond Market. A very, very warm welcome, ma'am. Next, moving on to the next panel member, Ms. Sandeep Pandey, CIO, Fixed Income, SBI Pension Funds. Mr. Sandeep Pandey is a Chief Investment Officer, Fixed Income at SBI Pension Funds, and looks after the fixed income and alternate asset portfolio of the company. He holds an MBA in finance and has cleared CFA Level 2 with over 2 decades of experience in asset management, investment banking, and fixed income investing. Next, I would like to invite on the stage Mr. Shamik Ray, Head Debt Capital Markets function at ICICI Securities Primary Dealership. He looks after the debt fundraising for corporates and investing in corporate bonds. He is an alumnus of IIM Bangalore and CFA charter holder. He has worked over 30 years with issuer and investors in debt fundraising and investing. Next, I would like to invite on the stage Ms. Sunaina Da Chunha. She's a co-CIO, Debt Aditya Birla Sun Life AMC. Ms. Sunaina leads overall credit portfolio of the company. She holds an MBA from FMS and CFA. Next, I would like to invite on the stage the moderator of this panel, Mr. Sri Ram Krishnan. He is a Chief Business Development Officer at National Stock Exchange of India Limited. He has over 28 years of experience in the Indian banking and capital market space. At NSE, he is responsible for business strategy, product lifecycle management, advocacy, stakeholder relationships, and market research and policy initiatives. Over to you, sir.
Thank you very much. And it's indeed a fantastic occasion for all of us to be participating in. I'm very, very thankful to SEBI for this initiative. I think this is a very, very timely initiative, any which way you look at it. The need for a mature and a deeper corporate bond market is perhaps bigger now than at any time in our history. I think, we've done well in equities. We've known the world over. But, the irony is that NSE first launched the corporate debt segment, not the equity segment, in June 1994 when we went live. So I think, when you look at it, for shorter term financing needs, banks are very good. But for longer term financing, particularly when it comes to financing infrastructure or housing or the energy transition or manufacturing, I think corporate bonds have a very, very important role to play. If you look at what we have been seeing in 2025, for example, out of the 15 lakh crores that were raised via bond financing, not bond financing, I should say fixed income financing, probably 9 lakh crores or so have been through CPs. And of the remaining 6 lakh crores, most of the bonds issued were unlisted bonds. So we have a couple of areas to think about why we don't see listed bonds that much more. That's one question. And what can be done to improve liquidity in the secondary market for bonds in general, whether we look at India in isolation or in comparison, it's a stark reality. India's the size of the corporate bond market is also extremely small in India. We are just about 16% of the GDP. There are other countries of the world where it's as high as 50, 60, 70%. So quite a few areas to talk about, including, of course, the most important aspect, which is liquidity. But I'm going to take a minute and request each of the panelists to quickly introduce themselves, and then we can get going with the questions.
Hi, I hope everybody's been having a very enlightening session since morning. This is Aditi Mittal. I am Director AK Group and the Chairperson for the OBP Association.
Good morning. I think very, very interesting session through the morning. I'm Neepa Sheth, Founder and Managing Director, Trust Group.
Good afternoon. This is Sandeep Pandey. I take care of fixed income portfolio for the SBI Pension Fund. SBI Pension Fund is a 5.4 trillion, 5.7 trillion fund with around 1.4 trillion of fund that we manage on the fixed income corporate bond side. I thank SEBI, NSE, and BSE for organizing this and making me part of this event. Thank you.
Yeah, hi. I had DCM at ISEC PD, which is short for ICICI Securities Primary Dealership. We are a bond arranger and we are also a corporate bond trader.
Hi, I'm Sunaina Dagona. I'm co-CIO debt at Aditya Birla Sun Life AMC Limited. We manage about close to 4 lakh crore AUM on the fixed income side.
Okay, with that, let me begin with Sunena. Sunena, from a mutual fund perspective, how do you think we can deepen the liquidity in the bond market? What steps can potentially be taken or considered if we want a more deeper liquid market, particularly in the secondary segment?
So let me look at it from two perspectives. Firstly, look at what the challenges that are being faced both by, let's say, investors at the time of issuance, as well as investors like us. So issuers at the time of investment, at the time of their issuance, like I think was discussed at the previous panel, when it comes to private placement of debt, it's extremely smooth. SEBI has come out with a lot of reform, as a result of which time to market is extremely short. But for an issuer who wants to deepen their exposure and the investor base that they have, they probably want to look at public issuances, which is less than 2% of total issuances that we have in our country. But for that, you have extremely detailed prospectus, which results in longer time to market. Also, because of the the kind of reporting, the kind of compliance is required for a public issuance, you also have very high secretarial costs. So the cost of issuance also goes up. So if you're looking at it from an issuer perspective, if they're looking at, let's say, public issuances, I think this is some challenge that they're facing from that perspective. As an issuer for a private placement, things are extremely smooth. As an investor, when you're looking at it, and our investors who invest in debt mutual funds, I think the big change happened about 3 years ago when taxation changed for debt mutual funds, and now there is a difference in taxation for various different asset classes. And unfortunately, because of the differential taxation that happens across asset classes, and the asset allocations are being skewed more towards the efficient tax allocators like equity, and unfortunately, perversely away from fixed income or debt mutual funds. So as a result, we've seen that over the last 3 years, the flows that come into the mutual fund, which is dominant in, let's say, the 1 to 5 year segment of the corporate bond market, has actually stabilized or stagnated. And hence the liquidity that had already built up over a period of time and over the many years in the corporate bond market actually has dried up to some extent in that segment, because mutual funds, as you know, is a very dominant player in the 1 to 4 year, 1 to 5 year category. So I think tax is a big challenge that is there because, due to the differential taxation in capital gains, investors of ours, as a result, get skewed towards looking at other asset classes which are more tax efficient. Also, investors, I think, because of the shallowness of the market, there is some amount of information asymmetry. There's some amount of pricing asymmetry. We need market makers. I think the previous panel also discussed that you need a proper framework that is built for market making so that you have a fairly active and vibrant secondary market. We have a lot of frameworks in place already: corporate bond repo, CDS markets, and mutual funds like us can participate and are participants to some extent. But I think to get it to the vibrant category, you need many more institutional investors also to be part of those markets. Also, a lot of institutional investors, other than, let's say, mutual funds, it could be pension funds or insurance companies, are restricted in the investments that they can make with respect to rating. So they're restricted to the higher rating categories. Now, when you're talking about liquidity in corporate bond markets, you're not really talking only about the AAAs. You need to be able to provide liquidity down the curve because, frankly, that's where liquidity is most required. But if you have some of the larger players, because of regulation not being allowed to participate in those papers, then liquidity will not be able to be generated.
You spoke about the challenges in listing. Do you think credit rating is a tough requirement? In some of the countries around the world, there's no requirement for credit rating when it comes to listing a bond.
So I think a lot of issuers are now used to credit rating and getting their bonds rated. So I won't think that's a challenge. But yes, deepening and changing the framework of the credit rating agencies, also deepening the kind of work that, let's say, the debenture trustee does, that could give some more confidence to people coming in. You're trying to develop the market, trying to, invite additional investors. You need to give them additional confidence, and that could come from, let's say, a credit rating agency or a very powerful debenture trustee.
Sure. The last couple of years, we've seen a new breed of market participants called the OBPPs, the online bond platform providers. So Aditi here is the representative voice of the OBPPs in this panel. Aditi, recent data seems to suggest that there is an increase in the number of transactions coming in from the OBPPs, particularly in the secondary market. How do you think OBPs can help this inventory-driven approach currently that we see to become a more broader approach that can help increase participation and sustain liquidity?
First of all, thank you, SEBI, NSC, and BSC for giving opportunity to what at least I call as a poor cousin of the financial markets. Finally, corporate bond is there, and we're getting that enough, let me say, for the lack of right word, the attention and the support from the regulators and from all the MIIs. Yes, I completely agree with you that OBPs have played a very crucial role in increasing the number of transactions on the RFQ platform because OBPs are the only market intermediary which does 100% of their transactions on the RFQ, which is also good for investor protection because all clearing of corporate bonds happens only through the exchanges for all investors. And to substantiate that, I'll give you some data. In 2021-22, and this is only for one exchange, this is primarily for NSC and it could be a little dated. The total number of transactions were only 9,812. So, which is about 5 years back. Fast forward 2025-26 till December, the number of transactions have jumped to 12 lakh 14,342. So what was a volume per year is a volume of number of trades per day. What has changed? The change has been brought in by technology. Whether it's equity, whether it's mutual funds, whether it's insurance, technology always played a very big role in bringing the scalability. Again, I would say regulators and MIS were very supportive in bringing the buy side of the transaction to be completely technology driven. And today, if you look at most of the platforms, within few minutes, between anything between 2 minutes to 5 minutes, you'll be able to buy the transaction. You'll be able to invest in a corporate bond. But when it comes to liquidity, you cannot only look at one leg of a transaction. It has to be buy and it has to be sell, which we have been speaking since morning. So now we should look forward to the support of the MIIs that we are able to automate the sell part of the transaction. And if that can also be made seamless, then the investor confidence will go up. And as we heard in the previous panel, OBPs have been able to actually bring down, or let me put it this way, introduce more issuers down the rating curve. We have mostly seen in corporate bonds being concentrated between AAA to AA. We have heard that 92% or rather 96% of the total issuances last year were governed by private placement. Within that private placement also, if you'll see, it was mainly from AAA to AA. But what actually OBP did is they gave an access to the issuers who were AA minus and below. They gave an access to the issuer, they spread the education to the investors, they showed an alternate investment avenue to them, they made necessary disclosures, and technologies helped all the investors to make a seamless investment. Now we will look forward to if the sell leg can also be technology driven. So that's one point of it. Second thing is in whether in equity, if you'll see, there is anonymous trading and there is a single window. So if we can look debt market also going towards anonymous trading and not be on the OTC, then people have more confidence in the liquidity. In equity, it is the screen, it's the terminals, it's the exchanges which brings in the confidence with guaranteed settlement. If we can introduce the same thing in debt over a period of time, can be very helpful.
No, it's a really, really interesting idea. You know, the anonymous trading concept, if it can be introduced for the corporate bond markets as well, I think that could be a game changer, and I completely agree with you on that. Let me now move to Sandeep, who represents the voice of the pension fund managers. Sandeep, pension funds are essentially long-term buy and hold investors. How important is secondary market liquidity at all? And do you really look at secondary market liquidity for that matter? I mean, because I think the portfolio churn is going to be very, very limited in your case.
Yeah, so firstly, I want to actually clear this perception that, pension funds, particularly talking about ourselves, that we are more passive. Why do we need a liquidity for a pension fund is the first question that actually I get across when I talk to people. But, you know, actually, when I'm evaluating any investment, these are one of the measures which actually, come across my mind by default, because if liquidity is available, I would always prefer that over a illiquid instrument. That's one part. Secondly, uh, looking at my portfolio, I have around 1.4 trillion of corporate bond. This portfolio has been built over a period of time, and you know, uh, today as we speak, with the rundown of the portfolio, probably 20-25% of my portfolio, which in terms of size is roughly around 30-35,000 crores, is in less than 3 year you know uh, bracket, or around 3 year bracket. So as a long-term investor, pension investor, if I have an opportunity to actually reduce this shorter duration papers and get into longer duration papers at the opportune times when the yields are at the peak, uh, that would help me in locking higher yield for a longer period of time for my subscribers. So that way, uh, liquidity is actually required for me in terms of overall value enhancement or yield accretion for the portfolio and for the subscriber. uh, but it has been a perception that the market perceives us in a way that we are more passive. We are categorized in that 23 to 25% of that market, which actually is hold to maturity category. But I think going forward, you will see more and more participation from the pension players in terms of in the secondary market as well.
Thank you. Shamik, the union budget that was announced a couple of days back has spoken about market making in framework and corporate bonds. And obviously, the government has some ideas. And in addition to market making, they've also spoken about encouraging municipal bonds with some incentives. And, while these are all great announcements, do you think the announcement or the framework itself would be good enough, or do you think there are some critical enablers that are further probably required, like we see on the banking side, for instance, the access to funding support through the liquidity adjustment facility or through the call money market and so on, that we see in the case of the government bond market? How do you think the corporate bond market can be energized through this framework more effectively?
So firstly, I would not like to focus on specific measures because some of these measures are sort of very early in the day. I think that our policymakers look and see what is not there and what can be there. It doesn't mean that it will be there tomorrow. So on the point of market making, I would say that market making does not happen abroad. It happens only for 30 days. For new issues, it doesn't happen post subsequent to that. I guess we should have a framework for voluntary market making where the institution should be large, financially pretty well regulated, tightly regulated to ensure that it has the capacity to do it and it has the capital adequacy. And if the market gives it opportunities, it should be able to do it. And when it does it, it may get some maybe regulatory additional limits. Maybe it should get some risk weights to be reduced to the extent that it is actively doing it. Maybe in case of funding stress in the market, let's say that in the GSEC market, you have a funding network which enables the overnight rates to stay within a range. In times of stress, you could have additional funding line been given to such market makers. But I'm totally against any subsidy, any targeted measure, which is not practical. So I think that this is definitely something we should work towards, but we should work towards it in a voluntary capacity. So we have some distance to go while we reach there, but this is the first steps we are trying to figure it out. On today's, session here, I think this is a great initiative from the regulator and assisted by the exchanges. I think that not only do people in the audience hear some ideas, but even those of us who are on this dais, we come here and we think that we are all busy doing our deals, managing our money, like I'm sitting between two active investors. And for people in the market, Sandeep does not have to say that he's an active trader. He has a mark-to-market portfolio, and the fact that there is a regulatory framework where an investor has a mark-to-market portfolio which encourages him to trade, encourages him to sell, encourages him to buy, is structurally a very sound thing. So essentially, our regulators have to see that we have more such investor classes, more such valuations where investors are encouraged to trade. One typical response I'd like to share with you is that, without naming any names, of course, that certain institutions are asked that why did you buy in secondary at this level? This was the only trade for that day. Is that the right level or is that the wrong level? The answer is don't buy in secondary. Buy only in primary. Why don't such, audits come and ask, why did you buy in primary when the secondary level in the last 1 month was 25 or 30 basis higher? We should have the government or the regulators implementing this and let there be efficiency in the market. We seem to have audit efficiency and we don't have market efficiency.
Thank you. One of the important focus areas for SEBI in the last couple of years has also been the RFQ or request for quote platform and how we can make that more effective for better price discovery. I wanted to ask Nipa next. While we see two-way quotes actively from brokers in the OTC market, we don't seem to see similar aggressive bidding on both sides in the RFQ platform. What are the constraints? Are they economic or are they operational? And what can we do to improve the dynamism of the RFQ platform?
So, first of all, thank you, SEBI, NSE, and BSE, to have this initiative where there is a voice on the corporate bond markets. Very well appreciated. I think very, very interesting and a very important question. So, if I have to look at a market, which market, and especially being in this market for over last 20 years, liquidity becomes the most important part of any market. I think over the last 5 years, after the certain incidents on Indian debt market, we've seen SEBI has bring in the simplicity and the transparency on the platforms. We've seen issuers coming. We have a database of all the corporate bond and cash flow. There is a standardization. There's EBP. There's information available. However, what is still missing is liquidity. Much better than what we were, but one would ask for much more than that. So though the brokers would put a two-way on an OTC market. I think when you put an RFQ, you're committing a fund and a level which you cannot check, recheck. However, even on OTC market, today the number of intermediaries in debt market would be effectively single digit in a wholesale market. And even if we take the OBPP platforms, we are still very, very small compared to any other markets. Even the number of participants and the base is that where do I fund this from? So I think as Mr. Bansal from SBI Capital also mentioned that for any market making, any intermediary or any institution either should have a profitability or the basis on which this is rewarded. So either it is compulsory for the issuer and some part may not be AAA because the very liquid AAA issuance don't want to spend that cost for market making. But for an intermediary, the funding cost is important. The net worth of LC Gupta is important. So I think there has to be a clear framework for the debt market intermediaries in terms of funding guidelines and the incentive that why there should be a market making in these activities. So we surely see RFQ is an interesting platform, but it is still limited to debt market players. I feel if we use an infrastructure of NSE and BSE existing equity markets, I think the reach could be much wider, and that probably could be a manner in which two-way courts can be created. Thank you.
Thank you very much. Just going back to Sunena, if you look at the assets under management of the asset management industry, equity assets have grown like crazy in the last many years. Somehow the AUM of debt funds seem to have shrunk a bit. What do you think we can do to help the debt funds regain their size and the lost glory?
I think we have to look at the timing at when that change happened, and it happened post April 23, when the tax regime changed. And I spoke about this a little earlier, that unfortunately, it's the tax differential that you have between these asset classes, equity and fixed income, that is perversely driving the asset allocation towards equity and away from fixed income. So while I know the budget has passed and, we in the fixed income markets were hoping for, some kind of parity with the other asset classes, but I think this is something that is really required in case we want to incentivize flows back into the market. And I'm not saying incentivize in the sense of a subsidy or an incentive. I'm saying it should be on par with other asset classes, so that an investor takes a decision based on asset allocation and not purely on tax and tax efficiency. So, till that period of time, debt as, within AMCs was always the substantial, if not the majority. I think that switch happened. For one reason, of course, it was tax, and of course, the second reason was the booming equity markets. But I think if I look at the trigger point, it was the change in taxation. So, if we can get that back at parity, I think that would be a starter to attract a lot more investments back into the fixed income markets.
Just to nudge you a bit more, do you think OBPPs can help you distribute the debt funds?
No, so I think all these platforms have added a lot to liquidity. As I said earlier, a lot of the institutional players do tend to stick to that AAA to AA kind of a segment. And frankly, when you go below AA plus AA, liquidity really dries up. It's the platforms, it's the OBPP platforms, the wealth management platforms that have created a market outside the institutional investors, and that's very important. But I think, actually you can get much more volumes, you'll get much more interest if you're able to just change this one, tax differential that we currently have.
Sandeep, much like what we see on the equity ETFs, where, for example, NPS is a big investor into ETFs, and when they buy, they just buy and hold for a very long time, and there's no secondary market trading generally that they get into. Likewise, you are on the fixed income side, long-term oriented investors, similar to insurance companies or other provident funds, etc. So, what is your commitment to improving secondary market volumes? Do you think we can encourage you to participate a little more actively in the secondary market? What would be your motivation for this to happen?
Yeah, so I thank Ms. Shamik for recognizing that we are already active in the market. Okay, so it's just that dil mange more types. The more we are, the better it is for the secondary market vibrant market. Uh, as I you know had a mention that 35%, 25%, which is 30,000 crores of my portfolio already is in a short duration, which I actually want to convert into a longer one, so that still, if I were to look at the maturity profile or the age profile of the subscriber, that would be somewhere around 10 to 15 years from hence, and hence I can manage ALM with that strategy. But structurally, the problem is that there is a segment or part of the yield curve where you have a good amount of liquidity, but there is a segment or the part of the yield curve where you have uh, you know actually no liquidity kind of thing. Again, within this, if I have to look at the credit rating profile also, largely 95% of the secondary market volume is in the AAA category. Good for us, because obviously we are also dominated by AAA portfolio. But I'll give you a live example. Few days back, I was sitting with the issuer, and the issuer was more like a long oriented, where they wanted to manage their PNL by locking in the interest rate, and they came to us saying that it's difficult to find long term players who are ready to lend us at for 7 and 10 year maturity profile other than you. So I was actually surprised as to why such a large private sector insurance, let aside the public sector, but private sector insurance, why they are not able to get capital, debt capital uh, for 7 and 10 year maturity. So their thought process was that they are getting from the mutual fund category, but that largely is in the 3 year and 5 year, and also the insurance players are also looking at 3 and 5 year. So my sense was that maybe is largely because the insurance also are looking for a liquidity aspect of that issuer, so that in case if the future they want to exit, they have a set of investor who can help them exiting the that investment. So I think we got to have, even for us, let's say I can exit my 3 year, less than 3 year portfolio through set of investors, which is mutual fund. But where do I get the replacement? Correct. So for that, I need to depend on the primary market only. So that's the issue that we have, from overall secondary market perspective. We are more than happy to actually, look at, participate in the secondary market in all ways.
Thank you. Shamik, I wanted to ask one question around the participation of foreign portfolio investors, or FPIs. FPI participation seems a bit low, and I have heard some feedback that some of the FPIs have reduced their exposure to Indian corporate bonds and the trading as well, because 10% of their trades have to be compulsorily routed through the RFQ platform. Do you hear such feedback from FPI clients that you deal with? Or what is your sense? What are key deterrents, and why are they not participating briskly enough?
As a primary dealer, we deal with overseas investors both in GSECs and corporate bonds. And the good news for us was that over the last year, we saw an excellent response from overseas investors on rupee bonds. We were, I think, this was partly because of the addition to the global indices, and we were in a sweet spot, rates were falling. So this was maybe after a 5-year gap when we hardly saw any inquiry on corporate bonds. The way we look at it is that the FPI investor takes a dollar return view. There was a period when the dollar rupee was fairly stable and they were making good returns. And instead of doing only in G-Secs, they were happy to come into corporate bonds. We also had a yield squeeze over the last 1.5 years on the non-AAA bonds. So sometimes we saw some specific FPIs looking at some corporate bond which is AA plus and saying that, let me get the yield squeeze on that and let me add to my returns. We also saw that there was a distinct preference amongst FPIs to work in issuers who also issue dollar bonds outside the quasis, outside the government-owned PSUs, because they would actively look at the dollar rates abroad and they would look at our rupee rates, swap it into dollars and see which is better. So there's an active market. There'll be seasons when the swap rate works against us, or right now the dollar rupee works against us. But it is good to see that with the sovereign upgrade and with, let's say, stronger credits in India, and of course we should have a positive rate cycle, the FPIs had come back. Sriram, I'd also just like to present a sort of wish list from my side.
Absolutely. Please go
This is
ahead.
a good forum to do that. I was looking back over the last few years, and there have been 3 great developments for our corporate bond from SEBI and other regulators. First is the EBP, and the good thing on this is that there are sort of constant tweaks to it. You have a product, it is good, but it can be better. So I see that SEBI has been fine-tuned. Continue. The REITs and the InvITs class has been set up some years back, and while the equity raise is maybe more in the headlines, the debt raise both at the short end and the medium to longer end gives a lot of assets to Sunana on my left and Sandeep on my right. You see that the pensions and the mutual funds are bought into this class, and this is one great development that infra for all the right or wrong reasons was shunned earlier at times. Greenfield infra was shunned. Operational infra in the form of InvITs has been loved. So this is another great change. The third is a change where I think still some work is left to be done. And I had asked a question on to the earlier panel on the ARCL on the corporate bond repo. Now this comes into liquidity for markets. How do you give liquidity? You give ease of funding. You give funding through the large players in the market who have a large balance sheet, getting large lines from the funding institution, which is the ARCL. They are able to place high quality AAA and AA plus bonds on the platform. You have the mutual funds who take the confidence that these are high quality bonds. These are high quality entities who are coming through ARCL, which is guaranteeing the trade. And if you have more such entities who are running portfolios, they will tend to buy more in primary, they will tend to buy more in secondary. The framework itself will create liquidity. So this is a great development, but what more do we need to do there? We need to bring insurance and banks into ARCL. We need ARCL to get a QCCP status from RBI so that, the banks have a lower capital charge lending over there. We need mutual funds to get the approval to lend more than 10%, depending on their liquidity, on the corporate bond repo. So several such requirements are there because this should not be a product, I'm talking from a borrower's perspective, where I borrow every day and quarter end suddenly I hear that the mutual fund did not have money, there was no lenders over there. You need the lenders across the market, and even Sandeep, I will request him to have a look at this, that obviously he's a long-term lender, but he looks for opportunities in the market to buy when markets sell off. And he will then use his short-term liquidity to transfer it to long-term liquidity. So I would look at even PFRDA giving, approvals to pension funds to lend in corporate bond repo, so that any market player who's solvent, who's large, can go there and run corporate bond portfolios.
Thank you very much for that. Deepa, your firm has been facilitating a number of client transactions in the tri-party corporate bond repo market. where we've seen daily volumes cross 5,000 crores recently. Do you see a spillover of that into the secondary market liquidity? And what more can we do to strengthen that space?
So, very interesting question. So, 2023, we saw birth of this repo platform. A great platform because you always had a lender in terms of, mutual fund were the promoters, so you would have a liquidity. And we started with a volume of around 2 to 3,000 crore per month in the next 2 months, which has now reached to 76,000 crore was the December 25 number, and 5,000 crore was a daily volume. However, let me cut this down that while this is very interesting and a very, very important, even today, we do not have more than 100 participants in this market. So while we talk about banks and insurance giving liquidity, which is very important, I think access to the market, one in terms of participants who all can access, I think even for a listed corporate, we have a very high requirement of net worth. So even if you see an RBI guidelines who are repo eligible participants, the number of participants who borrow in that market are very, very less. Second is this is a time where the yield curve is steep. If you see world over markets, a liquidity, a leveraged liquidity play is what makes corporate bond market very attractive to HNI and corporates. I'm not getting into retail right now. If you have a great platform, which ARCL is, because it also, allows a settlement which is guaranteed, I think some amount of tweaking in terms of to go below AA, probably allow a AA SO kind of security also to come. So number of security and number of participants, if it can increase, I think this is just the tip of the iceberg, what we've seen in terms of ARC repo. Apart from that, I think since we have the audience here, that even if you see the equity market, which is so buzzing, you can have any kind of equity shares which goes as a margin. But if you see the bonds which can be taken as a margin is only the AAA PSU bond or a government security. I think some amount of liquidity provided to the issuer, and it can allow a lot of participants to probably come in this there where people will look at as an alternative to bank deposits because liquidity will then be provided if they need it there. So I think access to repo platform to more participants will definitely be an ask, and more securities. At least go up to an A or an A minus level for it to have a great liquidity. We have done a great start, but I think there's a long way to go about it.
Thank you. Aditi, with multiple trading venues and products, we have RFQ today, we have the exchange cash markets, we have OTC, we have tri-party repo. Do you think the market structure will evolve in a way that there is a convergence, let's say, at some point in time, or do you think there'll be deeper and clearer functional differentiation?
So thank you for that question. Taking forward to what Nipa said, and it's been discussed that ARCL repo is a very important funding avenue, and funding is important for liquidity. Increasing the number of participants, and if an access to OBPs can also be provided, there could be new set of investors who can be made eligible here. There is enough excess liquidity sitting with, let me put it first with HNI and family offices, and then we can go down the curve. But only restricting them to the few members or to few eligible participants will eventually become the limitation of the liquidity. Second thing is also we have to see the speed of execution. Municipal bonds got approved as an accepted security, but it's still not been implemented. So, from the MIS perspective, also the speed of execution at the speed at which the market is opening up has to commensurate. They have to kind of talk to each other. Otherwise, there'll be a fatigue. Coming to now your point, Sriram, look at all the asset classes. That is the only asset class which has three avenues of trading, which leads to fragmentation. Because, and that can also lead to confusion. Because imagine you go to a shop for the same product, for the same soap, you are shown three brands, then you have to read everything, which brand to buy, how to execute. So similarly, you're having on cash, you're having an RFQ, you're having an OTC. So hence you are fragmenting the corporate bond market. If we are able to converge that into one platform, then you'll have all investors, or let me put it this way, traders, investors, buyers, seller on single platform, just as you have it in equity, and you will see volumes picking up, coupled with anonymous. Because these another problem or the limitation that we have in the debt market is the KYC. Since it's a OTC, we first need to do KYC. There are whims and fancies. Somebody will accept some counterparty, some people will not accept some counterparty, which will completely be done away with if it is anonymous, because you really do not know whom you're trading with. And then you will see going down the AA, and also that will answer your questions that brokers give two-way on the OTC and not on the RFQ, because then they will have to give the two-way. Everybody will have to give the two-way on a single segment of an exchange.
Thank you. My next question is for anybody on the panel. Anybody can answer this. We see still a lot of trading happening only in AAA rated bonds, not so many in the sub AAA bonds. Why is it so, and how can we improve some amount of trading in the sub AAA bonds?
See, this may not be a very, this may be a contrarian view, but I think we should sometimes look for contrarian answers. We have pension funds and insurance fund companies who don't want to lend to A or A minus companies in infra because that is not their mandate. And fair enough, they want the safest of assets. We have refinancing institutions who are okay lending to A or A minus assets because they know those sectors. And most of the time, there's no default. If there is a default, there is an underlying asset. That underlying asset is sold off. And as we know, the loss given default is very low. So actually, to the extent that risk-averse investors are lending to AAA, where the AAA is lending to A category, there's nothing wrong in it. I think as a system, we should stop beating ourselves and criticizing ourselves. Why is the money going to these institutions when we know it cannot go to the A-rated category directly? Having said this, yes, maybe we do have to find ways of giving money to AA, AA minus, A plus, and so on. But to the extent that AAA is the refinancing institution, I think this is a great thing which is happening.
Thank you. And my last question is one for all the panelists. What are the 2 or 3 reforms, whether it's regulatory or market driven or infrastructural, that you think we should undertake to improve secondary market liquidity? Aditi, maybe we can start with you.
I'm going to be, at the cost of repeating, I'm going to say the same thing. Sell leg of a transaction needs to be automated. It has to be as simple as investing in bonds. Second is anonymous trading, unification of all these segments into one. And third would be, I would like to touch upon is equity and mutual funds and insurance and FD market. One of the reasons for their success were the distributors, financial advisors, partners, whatever name we may take. Distribution guidelines around the distribution of debt securities coming from the policymaker can really help us taking this asset class to various corners of the of our country. Thank you.
Two very important market infrastructure. We have a gross settlement in debt. If we want more retail participants and more intermediaries to come in and the volumes to go up, I think to have a net settlement DVP3 on a single segment with an access to everybody on the same segment is going to be important. And second is the liquidity in terms of either repo or market infrastructure. I think two very important: the settlement and the liquidity for secondary market participation.
I actually want to start on a positive note that I mean there has been improvement in liquidity, but I guess it's not enough. So it's been talked that we need to increase participation from investor base. We also need to have more issuers coming in because as chairman sir talked about, there are very less number of issuers who are actually issuing serial on a serial basis. When I have these kind of names in my portfolio, actually I don't want to sell them largely because I also want diversification in my portfolio. So, let's talk about the retail part. So retail part, they can either come indirect route or they can come direct route. Direct route, as Sunena talked about, public issuances time takes a lot, And if we're talking about indirect route, it's largely the mutual funds where they are largely dominated by the institutional monies. So somehow we have to ensure that we are getting right participation through right exercise. And secondly, you know, what Aditi and Nipa both have been saying about that we need to have platform. NDS moment was the moment which actually led to increased secondary volumes in the government bonds. I think some similar kind of more structured products coming on a platform like NDS being, where you have a CCL kind of mechanism will definitely help the market to get more vibrant as against what we are seeing today.
Yeah, one comment before I come to my wish list. I think the primary liquidity in India is superb, and we don't have too many issuers complaining that I don't get money. Abroad, you have investors saying, I will not take more than 5% or 10% of any issue, and therefore the issues are large. I think investors in India realize that corporates are very opportunistic and they may not come again. So we don't have those requests in India. So we have corporates who are very keen to issue multiple times a year, and sometimes invest. And you wait for the listing to happen after 3 days, and every day the yields go up by 10 basis. So there was a time when we could trade the very next day after the investment. I would wish that we have some kind of systems and regulations which enable an overnight listing, because you're penalizing primary market. Is higher. The last.
In which they are allowed to invest. Maybe we increase those limits and increase the appetite so that it induces them also to step down the rating curve and rating spectrum. So in the short run, I would say this is my wish list. From a longer term perspective, it would take time, but I think we need to develop robust frameworks for market making. If we want to deepen liquidity in corporate bond market, it cannot be done in isolation. You need to also increase liquidity simultaneously in corporate bond repo, in the CDS market. So you need to ensure that all these are done in conjunction with one another so that overall the liquidity improves. And I think a stronger framework that gives comfort to different classes of investors who are now active participants in the form of, let's say,
a much stronger and a much, more institutionalized and much stronger framework for debenture trustees, as well as, credit rating agencies that also will probably add a lot more confidence to newer participants to come in.
Thank you. With that, we have come to the close of this panel, but maybe we have time for a question or two in case anybody wants to have a quick question. I think we have two people who want to ask questions. We'll take two questions and then, yeah.
A very engaging, very enlightening session. I'm Dr. Manisha Jain. I head the products advisory for Crystal.ai. Now, while the intent of bringing the retail participation into bonds is something which was much awaited, right? At the same time, when we discuss things as a wealth management platform with a lot of investors like family offices, with increased participation that we are trying to bring to the secondary markets. The one challenge which, of course, again and again, I kudos to Sunaina for highlighting that over and over again is taxation. All the more the pain of taxation when you compare your LRS investments and where we stack up on fixed income, because first your hold period on fixed income for qualifying for an LTCG is a year more as on date. So slab rate taxation will obviously be a deterrent. So glad to have thoughts there. Second, your yields, right? So today my AA or my A paper vis-a-vis what my dollar bonds are being able to deliver are not promising the kind of yields that we are seeing globally with the hammering of the rupee. So a lot of thought goes into how am I going to bring more and more investors to get attracted to our bond markets, right? So there is definitely a 5 to 6% depreciation that we are seeing on the currency. So these are some of the questions, and my question is very clearly to the people from the AMC background, that how do we combat when investors ask us these queries, because these are very genuine concerns and we've already seen drying up, significant dry ups. Second question, instead of me, telling an investor to find the kind of corporate bonds which are going to suit their requirement, I'm more than happy today to write a check to a mutual fund manager who does the active management, right? So don't you think that is also one concern which will emerge in bringing more and more retail participation to the direct bond market? So two questions.
So for the first question, as Sunana has been saying, I think that taxation part is not only for the mutual funds, it's across all the asset classes. What she said, and it was a very important statement that she made, that people should make a choice of investment in various assets based on their risk appetite and not on the base of the taxation benefit. So when we're talking about that taxation reforms in mutual funds, so similar taxation reforms should come into corporate bond market also, and that comes in for resident Indians and for the NRIs. So there should be a parallel treatment, and I'm sure policymakers and regulators and people on the top are cognizant about it, and that is something that they will have to deal with it. To come to your second point, when you're talking about LRS and you're talking about dollar returns on the bonds, dollar returns on the bonds also has a currency effect. So if you're going to couple both of them and then you're going to look at the Indian infrastructure, I think your answer to that would be dollar bonds of Indian issuers through the gift city. So that's how I would simply answer to you. So for them, if they have to invest in a PFC bond, whether it's a dollar PFC or a rupee PFC, the credit remains the same. So if people are going out of country, they can go through gift city. If they're coming into country, they can come through gift city.
Okay, I think there are no more questions. So thank you very much. I want to thank each of my panelists for their valuable time and all the contribution in this discussion. Thank you.
Thank you. We would like to present a small token of appreciation to all the panel members. May I request Mr. Krishnan Iyer, Senior Vice President, NSC, to join us on the stage. Thank you for that insightful and engaging panel discussion. Let's take one group photo. Thank you. And now, ladies and gentlemen, to formally conclude the proceedings, I would like to invite on the stage Mr. Debashish Bandopadhyay, CGM SEBI, requesting him to join us on the stage to present the vote of thanks.
Good afternoon, everyone. On behalf of the Securities and Exchange Board of India, I extend my heartfelt gratitude to all dignitaries, speakers, panelists, and participants who joined us today for the inaugural Pan India Bond Market Outreach Program. First, I would like to express our sincere thanks to Sri Tuhin Kanta Pandey, Chairman SEBI, for his insightful address and for launching the OBPP tagline documentary and videos. We are equally grateful to Sri Amarjit Singh, whole-time member SEBI, for setting the tone this morning with his opening remarks, and to the leaders of both the exchanges, Sri Ashish Kumar Chauhan, MD and CEO NSE, and Sri Sundar Raman Ramamurthy, MD and CEO BSE, for sharing their perspectives on how the market infrastructure institutions can collectively deepen our corporate bond market ecosystem. I extend special appreciation to our esteemed panelists from LIC, CRISIL, SBI CAPS, NAPFED, and UB, and to the speakers in our second panel from ICICI Securities, PD, SBI Mutual, SBI Pension Fund, Aditya Birla Sun Life AMC, Trust Group, and AK Group. Your contributions have provided valuable clarity on fundraising avenues, liquidity considerations, credit perspectives, investor expectations, and digital platform led market access. A warm thank you to our moderator, Ma'am Maninder Chima, Executive Director SEBI, and Mr. Shivramakrishnan from NSE for steering the discussion so effectively and ensuring that today's conversation remains practical, meaningful, and sharply focused on issuers' needs. To all participating mid corporate issuers, investors, market intermediaries, and ecosystem partners, your presence reinforces our collective commitment to making India's corporate bond market more accessible and inclusive. Finally, I would like to acknowledge the dedicated efforts of the organizing teams from SEBI, BSE, and NSE for curating today's program and ensuring a seamless experience for all. Thank you once again for your participation, your time, and your continued engagement. We look forward to working together as we expand and strengthen India's bond market landscape. Thank you.
Thank you, sir. And this brings us to the end of this conference. Thank you for your valuable participation. With this, Anchor Mayuri Malankar signing off. Have a wonderful day ahead. Also, please join us for lunch. Thank you.